So, yesterday we completed section 40, capital A subsection 3, but in that we need to still discuss we need to discuss exceptional situations which are given in rule 6DD. But before I actually move on to those exceptional situations, let me first once again go through situation 8 and 9, because I got one doubt from one of the students saying that situation 8 and 9 there was some confusion. See, situation 8 and 9, if you recollect, this diagram was shown to you. Here I am purchasing goods from a relative, and what is the transaction value? Transaction value is 15,000, and what is the fair market value of goods? 12,000. So in this case, what is going to happen? Transaction is entered for 15,000, entire 15,000 is paid in cash, and the fair market value of goods is 12,000 rupees. So first we are going to apply which section? Mandatorily mic is turned off. Yes. So I am revising transaction number 8 and transaction number 9. That is example number 8 and example number 9. In example 8, I had given you the numbers saying that transaction value is 15,000 rupees and the payment is made in cash. So in that case, the fair market value was 12,000 rupees. So what is the excess payment to relative? Excess payment to relative was 2,000 rupees. Difference of 15 and 12, that is 3,000 rupees. So what will be disallowed? Or let me write for you. Example number 8. Transaction value is 15,000. Payment is made in cash. Fair market value is 12,000. So in this case, what will be disallowed in section 48(2)? In section 48(2), how much will be disallowed? Excess payment to relative, 3,000 will be disallowed. And in section 40 capital A3, how much will be disallowed? 12,000 will be disallowed. Is that very clear? Example number 8. Do you have any doubt? Example number 9. Transaction value is 12,000 rupees. Payment is made in cash. Fair market value is how much? 9,000 rupees. So it is mandatory for you to apply which section first? It is mandatory for you to apply section 40 capital A subsection 2 first. So in section 40 capital A subsection 2, how much will be disallowed? 3,000 will be disallowed. What about section 40A3? In section 40A3, nothing will be disallowed. Why so? Because the amount after disallowing 3,000 in 40A3, what is left is only 9,000, which does not exceed 10,000. In other words, what is going to happen? Out of transaction value of 12,000, which you might have debited to your profit and loss account, for 3,000, deduction will be disallowed, and for remaining 9,000, deduction will be allowed. Yes. Remaining 9,000 deduction will be allowed. Is that very, very clear? Yes or no? Kindly drop me the message. Anyone, if you are having any confusion? No confusion? Great. So now let's move on to rule 6DD. What is rule 6DD? Rule 6DD is giving you certain exceptional situations wherein section 40 capital A subsection 3 will not be applicable. Section 40 capital A subsection 3 will not be applicable. Rule 6DD is giving you certain exceptions. So in this case, even if the payment is made in cash, nothing will be disallowed. In other words, entire amount will be allowed as deduction. Entire amount will be allowed as deduction. So let's move on to rule 6DD and let us try to understand which are those transactions or which are those situations wherein entire amount of expenditure can be allowed as deduction irrespective of whether the payment is made in cash or it is made by account paycheck. The mode of payment does not make any difference. Entire amount will be allowed as deduction in certain exceptional situations. Number one point, we are on page number 137 of your textbook. We are moving on to discuss the exceptional situation wherein 40 capital 3 is not applicable. So entire amount will be allowed as deduction. Number one is payment is made to bank. See, if you cannot make the payment to bank in cash, if you cannot give cash to the bank also, then what is the purpose of cash in the economy? Why the cash is made? So government says to the banks, if you want to make the payment, we don't have any issue. So say for example, some bill of exchange is discounted with the bank and now the maturity has arrived. So if you want to, on the maturity, bill is discounted, on the maturity you want to make payment to the bank. If that payment you make by cash, if that payment you made in cash, nothing will be disallowed. So if you are making payment to where the payments are made to banking and other credit institutions, okay, where payments are made to banking and other credit institutions, RBI, LIC of India, etc., then in that case we say that section 40 capital A subsection 3 is not applicable. So you make payment to bank, financial institution, RBI, or you make payment to LIC. LIC is a government of India's company only. So government has given some relaxation there. So if you make payment to these institutions, then 48(3) will not be applicable. In other words, if you are making a payment of life insurance premium to LIC of India, then you can make payment in cash. But the question is whether they are accepting or not. If at all they accept, then you can make payment in cash. The government doesn't have any issue. Number two, payment to government. See, right now there was one duty called as octroi duty. Octroi duty is totally stopped right now. No state is having an octroi duty. Octroi duty is nothing but the duty which was levied when the goods were transferred from one district to another district within the same date, within the same state. So within the same state, if you transfer the goods from one district to another district, you have to pay octroi duty. Means octroi duty was a duty levied on movement of goods within the state. Now that octroi duty is totally stopped. So octroi duty collection is always done in cash only. When the octroi duty was prevalent, collection was always done in cash. So on one hand, the government says you pay octroi duty in cash, and on the other hand, in the Income Tax Act, if they disallow you the deduction, then it is like double standards. It is like government is adopting a double standard. At one point, they are saying that you make the payment of taxes in cash, and then they are disallowing those octroi duties, etc. Therefore, government says if some payment is required to be made to the government itself, and that too it is required to be made in a legal tender. Legal tender means it is required to be made in a payment is required to be made in cash. In that case, section 48(3) will not be applicable. This situation we have put it into a exceptional situation. So where the payment to the made it to the government, and such payment is required to be made in a legal tender, means the payment is required to be made in a cash. In that case, 48(3) would not apply to such a situation. Point 3. See, now there is no direct, what is the meaning of direct deposit in receiver's bank account? That will cover up in the further points. Don't worry about that. That will cover up in further points. That point I'll be covering up in further points. Third point is payment through banks. Payment through banks. See, now already government has given, CBDT has given rule 6A BBA. Earlier also in rule 6DD, there was an exception saying that if you make payment through banking system, then nothing will be disallowed. See, section 40A3. Earlier it was using the word you make payment by account pay check. You make payment by account pay check. Number 2, account pay bank draft. Or number 3, ECS through bank. Number 4, other electronic mode. Now, for a long span of time, only first 2 points were appearing. These 2 points are recently inserted. These 2 points are recently inserted. So earlier, this payment through ECS, other electronic modes, was given in rule 6DD itself. It was given in rule 6DD itself, but all the nature of payment through bank were not given. But now there is no importance of this point, because it says that you make payment through ECS through a bank, credit card, debit card, etc. Then rule 6DD will cover that transaction. 40A3 will not be applicable. But anyway, now we have rule 6A BBA, which says that you make payment by debit card, credit card, RTGS, NEFT, IMPS, BHIM, UPI, etc. Then 40A3 will not be applicable. Nothing will be disallowed to you. So this point number 3 has lost its relevance because of the new rule, that is rule 6A BBA. Next is payment by book entry. Payment by book entry. Have you completed a chapter called as amalgamation in accounts? Amalgamation chapter is over. Yes, amalgamation. Do you know something called as intercompany debt adjustment? Intercompany debt adjustment? No. Say for example, these are my books of accounts and these are books of accounts of Manoj. Now there is first transaction. I have purchased goods from Manoj. I have purchased goods from Manoj. So what entry I will pass in my books of accounts? I will pass an entry purchase account debit to Manoj's account. So I will pass an entry purchase account debit to creditors. I have purchased goods on credit basis from Manoj. So I am passing an entry purchase account debit to creditors account. In other words, I am passing an entry purchase account debit to Manoj's account. Say for example, I bought goods worth 20,000 rupees. What entry Manoj will pass? Manoj will pass an entry debtors account debit. Debtors account debit 20,000 to sales account 20,000. So this first transaction, I have purchased goods from Manoj. So I have passed an entry in my books of account purchase account debit to creditors account, and Manoj has passed entry in his books of accounts debtors account debit to sales account. For me it is purchases, so for Manoj it is sales. Now say for example, second transaction is I have sold goods to Manoj. I have sold goods to Manoj on credit basis worth say 15,000. So what I will pass entry in my books of accounts? Debtors account debit 15,000 Basically it is Manoj's account debit 15,000 to sales account 15,000. What entry Manoj is going to pass in his books of accounts? He will pass an entry purchase account debit. I have sold goods to Manoj, so Manoj has purchased goods from me. So what entry will be passed? Purchase account debit to creditors account. Creditors account 15,000. I repeat, first transaction from my point of view, first transaction is purchases. So I have passed an entry in my books of accounts. How much? Purchase account debit to creditors account 20,000. And second transaction from my point of view, it is sales. So I have passed an entry debtors account debit to sales account 15,000. Now forget about Manoj. You think only from my point of view, I have to pay 20,000 to Manoj because Manoj is my creditor. At the same time, I have to collect a 15,000 from Manoj. I have to pay him 20 and I have to get 15. So what I'll do? I'll do the net off and I will pay how much? I'll pay only 5,000 rupees. I'll pay 5,000. But what entry I'll pass in my books of accounts? I have to pass some entry in my books of account. Na? What entry I'll pass? Are you understanding this? There are two transactions, purchase transaction and sale transaction. For purchase transaction, Manoj is my creditor. For sale transaction, Manoj is my debtor. So Manoj is my creditor to the extent of 20,000 and he is my debtor to the extent of 15,000. So I have to make payment of 20 and I have to receive 15,000. So what I am going to do is, I am going to do the net off of the smaller amount. 15,000 will be adjusted. So debtors and creditors will be adjusted against each other to the extent of 15,000. Only a payment of 5,000 will be made. So, but that also I need to pass an entry in my books of accounts. So I'll pass an entry creditors account debit. How much? 20,000 to 15,000 I am adjusting against debtors. So to debtors account. Creditors account debit how much? 20,000 because purchase transaction was for how much? 20,000 rupees. To debtors account 15,000 and to bank account 5,000. This is the entry which I will be passing in my books of accounts to settle the transaction. So this 15,000 is paid through bank. Say for example, this was paid by account pay check. So on this we are not going to apply 40A3. Section 40 capital A subsection 3 is not applicable, means deduction will be allowed for this. Section 40A3 is not applicable, means deduction will be allowed for this. What about this 15,000? Do you believe that the payment is made by account pay check? No. Do you believe that the payment is made by account pay, bank draft, ECS, debit card, credit card, NEFT, BHIM, UPI, etc.? Answer is no. So payment is not made by any mode which is given in section. Payment is made by other modes. This we call it as payment by book entry. This 15,000 is nothing but payment by book entry. See, when you pass an entry in your books of account, creditors account debit to debtors account, definitely payment is not made by the prescribed mode of payment, but this does not generate any black money in the economy. If you circulate the cash, if you make payment in cash, definitely some black money will be generated in the economy. But when you make payment just by passing a book entry, creditors account debit to debtors account, in such cases, we say that black money is not generated. So in that case, section 40 capital A subsection 3 is not applicable. 40 capital 3 is not applicable means what is the consequence? Deduction will be allowed for the expenditure. Deduction will be allowed for the expenditure. Even though payment is not made by account pay check, account pay bank draft, etc., deduction will be allowed because making payment by passing a book entry does not create any black money in the economy. Have you understood this point? Yes. This is called as payment by way of book entry. So I move back to the textbook, page number 137. Here it is written payment by way of book entry. Payment by way of book entry means adjusting the asset against the liability, adjusting the debtors against the creditors. So on the left hand side margin against point number 4, if you want to write, you can write creditors account debit to debtors account. You can write creditors account debit to debtors account. Now let's move on to point number 5. Point number 5 says, if you have made any payment to cultivator, you are making payment to whom? Cultivator, grower or producer. For what? For purchase of produce of agriculture, forest, animal husbandry, etc. See, just talk about 5 years, 7 years back. There were a lot of people in India who were not even having the bank accounts. There were a lot of people in India who were not having the bank account also. After the new government came to power in 2014, they have opened around 6 to 7 crore bank accounts. Now they can confidently say that every family in India will have at least one bank account. So one member in the family is having a bank account. But I still remember before 2014, there were a lot of people not having the bank accounts. Entire family was not having the bank account. So in rural areas, there are a lot of farmers who are not having the bank account. Now the point is, if you want to purchase say food grains or the produce of the farmer, in that case, you were forced to make payment in cash because that farmer is not having a bank account. Therefore, government had inserted this point number 4 in rule 60D, saying that if you are purchasing something from the producer, you are purchasing agriculture produce, forest produce or produce of animal husbandry directly from the producer, grower, in that case, section 40 capital A subsection 3 will not be applicable. Deduction will be entirely allowed to you because they were not having the bank accounts. Now the point is, examiner would not ask you this question in the examiner. What he will say, the examiner will not ask you this question in the exam. What he will say is, Mr. X has purchased goods from a wholesaler. Mr. X has purchased agriculture produce from the wholesaler and is making payment of 25,000 in cash. So what you will do? Will you apply section 40 capital A subsection 3 and disallow the expenditure, or you will not apply and you will say that it is covered by rule 60D? See, rule 60D is applicable only when you purchase from the cultivator, grower or producer and you are making payment to cultivator, grower and producer. So if I am a wholesaler, I go to the farmer and I purchase his produce, I make the payment in cash, then rule 60D is applicable. 48.3 will not apply. Deduction for the expenditure will be allowed because those farmers are not having the bank account. Another possibility is I am a retailer. I go to the wholesale market, wholesale food grain market, and I purchase grains from the wholesaler and I make payment in cash. What will happen in that case? The situation will not be covered by rule 6DD. It is not covered by the exceptional situation. Section 40 capital A subsection 3 is applicable. If I make payment of more than 10,000 by cash, then entire amount will be disallowed to me. Why? Because that wholesaler is neither an cultivator nor a grower nor a producer. So if you make payment in cash to the wholesaler for purchase of food grains, etc., entire amount will be disallowed if it is more than 10,000 rupees. Is that very, very clear? Yes or no? Yes. So with this you have completed point number 5. Next is point number 6. Point number 6, payment to a producer for purchase of products of cottage industry. See, cottage industry they have defined to mean very small scale industry, not using electricity. See, as of now, 21st century, can you think about small industry even not using the electricity? I can't think of that. But very less industries might be there, very small scale industries, like say for example, making a pot out of the mud. In all those small very small scale industries, electricity is not used. the pots are made manually, pots are made, so there is no supply of electricity. In such cases, if you are making payment to such people who are into very small scale industries and they are not even using the electricity for the manufacturing activities, in that case government say don't apply them section 40 capital subsection 3. So if we make payment to them, in that case nothing will be disallowed to, in that case nothing will be disallowed. So payment is made to producer for what? For purchase of products of cottage industry. I gave you an example that from the mud they are making the pot, so they are not using the electricity at all. So if you make payment in cash to such people, in that case even if it is an expenditure for you, even if the amount is more than 10,000, even if you have made payment in cash, nothing will be disallowed, because the other party is a very small scale, is engaged in very small scale industry, and that too without using the electricity. Is that very, very clear? Yes, point 6 is clear. Point 7. Point 7. Point 7 says payment is made to a villager. Payment is made to a villager. Payment is made in a village. Payment is made in a village, and such village is not served by any bank. So 3 points are applicable here. Number 1, you are making payment to a villager. Villager means a person residing in a village or having his business or profession in that particular village. So number 1 parameter is you are making a payment to a villager. Number 2, you are making payment in that village itself. And number 3, that village is not served by any bank. So in that village there is no bank. There is no bank. In such cases practically it will be difficult for us to make. We can make payment by check also, but it is difficult for the other person to get it in cash, because in his village there is no bank. So government says if you are making payment to a villager in a bank and that bank is not if you are making payment to a villager in a very small village and that village is not served by any bank, then we will not apply section 40 capital A subsection 3. If we won't apply section 40 capital A subsection 3, entire expenditure, even though it is paid in cash, entire amount will be allowed as deduction. Entire amount will be allowed as deduction. Is that very clear? Yes. Point number 7. Point number 7. Point number 7, anyone if you are having doubt? Okay. Now let's move on to point number 8. Point number 8 says that, point number 8 says you have done the payment of terminal benefits. You have made payment of terminal benefits. Terminal benefits means gratuity. When a person retires, you pay him gratuity, or after retirement you pay him monthly pension. He can commute his pension. You might have heard something called as gratuity, or you might have heard something called as provident fund, etc. When an employee retires, you pay him gratuity, you pay him provident fund amount. So point number 8 says that employee has retired and you are making payment of gratuity, provident fund, retrenchment compensation, etc. to employee, and the amount of such payment does not exceed 50,000 rupees. If you are making the payment of gratuity, provident fund, etc. to the employee at the time of retirement and the amount does not exceed 50,000 rupees, in that case even if you make payment in cash, nothing will be disallowed to you. So see, a person who is retiring and getting a gratuity of only 50,000 might be a very small person. His salary might be very meager, 5-6,000 rupees. To such an employee, if you make payment in cash, nothing will be disallowed to you. So small transactions are kept outside the purview of section 40 capital A subsection 3. Yes, shall I proceed further? Point number 8 is clear? Yes, okay. Point number 9. Point number 9. See, I am talking about before 2010. Before 2010. See, as of now, say for example, you have opened a bank account with State Bank of India, Chennai branch. You opened a bank account with State Bank of India, Chennai branch. Now we are visiting Coimbatore. From Coimbatore, can you operate your account from State Bank of India? If you opened a bank account with a State Bank of India, Chennai branch, can you operate that bank account from the Coimbatore branch of State Bank of India? Answer is yes. As of now, it is allowed, but just before 12-13 years, it was not allowed. As of now, even you can use the ATM of some other bank. Just a few years back, that was also not allowed. Few years back, 10-15 years back, you can use the ATM of only that bank in which you are having a bank account. So, if you had opened a bank account with State Bank of India, then you can withdraw money only through the ATM of State Bank of India. Now, you can use any ATM, you can operate your account from anywhere in India. So, this point number 9, partially it has lost its relevance because of this full-fledged transparency in the banking system, that you can operate a bank account from anywhere in the country, and you can even use the ATM belonging to other banks. See what it says. Point number 9 says payment of salary is made to an employee. Point number 9 says what is paid? Salary is paid to an employee. Employee is temporarily posted for greater than equal to 15 days, either on a ship or at a place other than his normal place of duty, and at such place bank account is not maintained by him. For example, I am talking about situation prior to 10-15 years. In those days, say for example, someone was transferred from Mumbai to Chennai for say 1 month's time. In that case, if he does not maintain any bank account in Chennai, then he cannot operate his Mumbai bank account from Chennai. So he does not have access to the banking system. In those days, if you make payment in cash to him, that was allowed as deduction. Right now, this point has practically become redundant. But there is one point here. If the person is working on a ship, say for example, you are a crew member of a ship. So when ship goes outside India, it will come back after 4-5 months. And during those 4-5 months, if salary is paid to you on a ship in cash, then nothing will be disallowed to the shipping company. For example, you are working as a employee, you are working as a crew member of a ship with a shipping company. Ship is going outside India, and that ship will come back after 4-5 months. During that 4-5 months period, you are working on a ship. So definitely it is very difficult for you to have an access to your bank account during that period. If some salary is paid to you in cash, nothing will be disallowed. Now you may wonder why cash will be required on a ship. So on a ship, inside the ship also you have hotel, etc. So definitely you can spend money. So definitely all those employees who are working as an employee, all those people who are working as an employee on a ship, we can make payment to them of a salary in cash. In that case, that transaction will be covered by the exceptional situation. It is covered by Rule 6DD. Section 48(3) will not be made applicable. In other words, entire amount of expenditure will be allowed as deduction. Yes, have you understood this point number 9? Point number 9 is clear? Okay. Point number 10 is very simple. Payments are made on a day on which banks are closed. Payments are made on a day on which banks are closed. Why the banks are closed? Either there is a holiday or there is a strike of employee. Banks are closed either on account of holiday or on account of strike. In that case, if you make payment in cash, nothing will be disallowed. See, these points are very old points, and even the examiner sometimes is testing these points in the examination. Nowadays, you know that even if the bank is closed, you can make the online payment. IMPS payments can be made even when the banks are closed, even on the day of holiday. So there is no point in making a cash payment. So actually this point has become redundant. It should be removed, but it is still not removed from Rule 60D. So it says if the banks are closed either on account of holiday or on account of strike, in that case if you make payment in cash, nothing will be disallowed to you. Next is payment made to an agent. Payment made to an agent. Now let me explain you. Say for example, I am doing my business. In my business, I am purchasing goods through an agent. So there is an agent. I am purchasing goods through this agent. There is a seller. Agent will go to the seller. He will make payment and he will receive goods. These goods he will transfer to me. So for me it is purchase. Purchase of goods from agent. Purchase of goods from agent. And I'll be making payment to whom? Definitely I'll be making payment to agent only. I'll be making payment to agent. So in this, the first event that would take place is payment to an agent. First of all, I'll make in payment to agent. Thereafter, payment will make, first of all, I'll make a payment to agent, and thereafter the agent would make in payment to the seller. Agent would make in payment to the seller on my behalf. Then seller would supply goods to the agent and agent will supply goods to me. This is the order in which the events would take place. This is the order in which the events would take place. So first event is I am making payment to my agent. Second event is agent is making payment to the seller. So agent is purchasing goods on my behalf. Thereafter, seller is supplying goods to an agent, and the last event is agent is supplying goods to me. See, when the first event takes place, what entry I would pass in my books of accounts? When I make payment to an agent, what entry I would pass? Definitely I would pass an entry, agent account debit to cash bank account. Agent account debit to, say I have made payment in cash. So in that case, I'll pass an entry, agent account debit to cash account. Now, if you see this entry, both the accounts involved in the entry are balance sheet accounts. This account will appear in the balance sheet asset side. This cash will also appear on the balance sheet asset side. My cash balance will get reduced. So this will be deducted from my cash balance. Both accounts involved in the journal entry are pertaining to the balance sheet. They pertain to the balance sheet. In that case, I have not debited anything to my profit and loss account. Since I have not debited anything to my profit and loss account, I am not claiming any deduction. I am not claiming any deduction. If I don't claim deduction only, there is no question of disallowance. If I don't claim deduction, there is no question of disallowance. Question of disallowance arises only when I have debited something to my profit and loss account and I am asking deduction for it. Only when I have debited something to my profit and loss account and I am asking deduction for it, only in that situation, question of disallowance would arise. So in this case, question of disallowance does not arise. Question of disallowance does not arise. Have you understood this? Yes. Have you understood the entry which is being passed in my books of accounts on happening of the first event? Yes or no? Okay. So here both the accounts which are involved in the journal entry, they are balance sheet accounts. Nothing is being debited to my profit and loss account. Therefore, I am not claiming deduction for anything. Therefore, nothing can be disallowed to me. Now, when the agent is making payment to the seller, is he making payment on my behalf? or he's making a payment for the transaction which is entered by himself? That is the question. So here agent is a dependent agent. Agent can be of two types. Either agent can be an agent can be dependent agent or an agent can be independent agent. If a agent is a dependent agent, meaning thereby he is not working for himself, he is working for his principal. Dependent agent is not working for himself, he is working for the principal. Whereas independent agent, he is working for himself. So in this situation, this agent is a dependent agent. So he is not working for himself, he is working for me. So when this agent is making payment to seller, he is making payment to seller on my behalf. So when the agent is purchasing goods from the seller, what entry I would pass in my books of account? Na? I will pass an entry, purchase account debit to agent account. I will pass an entry, purchase account debit to agent account. So agent is making payment to the seller on my behalf. Then he has received the goods. This goods he will send it to me. So I have purchased the goods through an agent. I have purchased the goods through an agent. So I have already made a payment to agent. Now goods are being purchased. So I will pass an entry. If the agent is a dependent agent, he is not working for himself, he is working for me. He has purchased goods on my behalf. Now I am making payment. I have already made a payment to agent. Agent is making payment to the seller. Seller is supplying goods and agent in turn supplies those goods back to me. In that case, I would pass an entry. Purchase account debit. Purchase account debit to agent account. Purchase account debit to agent account. Now, this purchase will be debited to my profit and loss account. This purchase will be debited to my profit and loss account. Question is whether something should be disallowed to me or not. Whether something should be disallowed to me or it should not be disallowed to me. That is the question. So the point is, here if you look at the transactions, how I have made the payment. I have made a payment in cash to the agent. The first entry was agent to cash and then the entry is purchase to agent. Credit agent debited gets cancelled. So the net entry is purchase account debit to cash account. In that case, government says that agent is a dependent agent and he is working for you and you have made payment in cash to the agent and further payment which is made by the agent to the seller also, that is also made in cash. In that case, disallowance would apply. In that case, section 40 capital A subsection 3 will be applicable and disallowance would apply. To whom disallowance would apply? Definitely not to the agent, because agent is not going to debit his profit and loss account when he is purchasing goods. I am going to debit my profit and loss account when the agent is purchasing the goods, because agent is purchasing goods on my behalf. See, if you recollect, in CA Foundation you had one chapter called as consignment. In consignment, the consignee is a dependent agent. So when the consignee is selling the goods on behalf of consignor, then the sales entry will not be recorded in the books of consignee. Sales entry will be recorded in the books of the consignor. So it is a sales for the consignor. When the goods are sold by the consignee agent, it is a sales for the consignor. So there the consignee was a dependent agent. He was not working for himself, he was working for the consignor. So in case of a dependent agent, if at all section 40 capital A subsection 3 is required to be applied, then it is required to be applied not in the hands of an agent but in the hands of a principal. So when I make payment to an agent, the entry is agent account debit to cash account. But when agent is making further payment to the seller of the goods, if he is making payment in cash, then he is making payment on my behalf. In that case, if the amount of more than 10,000 is paid in cash, disallowance would apply, but disallowance would not apply to the agent, because agent is not going to debit his profit and loss account. I'll be debiting my profit and loss account when I have purchased the goods. So in that case, disallowance can be made applicable to whom? To the principal, not to the agent. Is that very, very clear? Manoj is asking me question. Manoj, you are asking 40 capital A subsection 2, excess payment to relative. Yes. So which section you are referring? You have written section 40 bracket 2. Oh, cash transaction is 40A3. 40A3. See, if the agent is a dependent agent, disallowance will apply to principal. Disallowance would apply to principal. If agent is a dependent agent, he is making payment in cash, he is making payment on behalf of the principal. So if at all disallowance is required to be applied, it will apply to whom? It will apply to the principal, not to the agent. Is that very, very clear? Why disallowance is not applicable to the agent? Because agent is a dependent agent. He is not working for himself. He is working for the principal. So disallowance should also be made applicable to the principal. Yes? Is that very clear? Yes or no, Manoj? Yes, okay. Now, second situation is agent is an independent agent. Agent is a independent agent. What do you mean by an independent agent? Independent agent means he is working for himself. He is not working for the principal. He is working for himself. And when an independent agent purchases the goods or sells the goods, he is selling goods, purchasing goods, he is entering into a transaction on his own. When he will purchase goods, he will debit his own profit and loss account. When he will sell the goods, he will credit his own profit and loss account. So in case of an independent agent, if at all you want to apply the disallowance, you have to apply the disallowance to the agent only, because he is working for himself. So in case of independent agent, we say that disallowance will apply to agent. Disallowance will apply to agent. Yes, have you understood? Have you understood this, both things? Yes, please respond. Have you all understood these 2 points? Yes. So one line conclusion is what? What is one line conclusion? If the agent is a dependent agent, when you make payment to agent, disallowance cannot be applied. When agent is making further payment on your behalf, if he makes payment in cash, disallowance will apply. To whom disallowance will apply? Disallowance will apply to the principal, because the agent is a dependent agent. What is another possibility? Another possibility is agent is an independent agent. In that case, disallowance would apply to the agent itself. Hopefully, friends, this is very much clear. So we want to, once again, we want to page number 138 of your textbook. Payment is made to agent. Let us read this. Where the payment is made by any person to his agent. Any person means principal. When the payment is made by principal to his agent, who is required to make payment in cash for goods or services on behalf of principal. On behalf of principal. In that case, what is going to happen? In that case, see, point number 11 is talking about a transaction in which you are making payment to an agent. In that case, it is covered by rule 60D. Why it is covered by Rule 60D? Because it is a balance sheet entry, disallowance cannot be applied. It is a balance sheet entry, disallowance cannot be applied. But agent is making a further payment in cash on your behalf, then definitely disallowance is going to apply, and disallowance will be applicable to the principal, not to the agent. So with this, point number 11, exceptional situation is over. Now we move on to the last point of exceptional situation, that is point number 12. That is payment is made by money changer. Payment is made by money changer. Now listen to me very carefully. For example, you want to travel to USA. When you want to travel to USA, you will have to take dollars with you. Na? Indian currency will not work there. So what you will do? You will go to a money changer. You will go to a money changer. You cannot give a check to the money changer in Indian rupees and say that you give me dollars. You take dollars and then your check will get bounced. So money changer will accept money in cash only, and he will exchange the money in cash only. So I go to a money changer, I give him Indian rupees. In turn, money changer will go to RBI. He will give Indian rupees. In exchange, he will get US dollars. And that US dollars, he will give it back to me. So in that case, if you think from the point of view of money changer, all his transactions are in cash only. He is purchasing currency, he is selling currency only. So all his transactions naturally would be in cash. If you apply the disallowance to the money changer, saying that if you make payment of more than 10,000 in cash, then the all transaction will be disallowed to him. Everything will be disallowed in that case, because he is dealing in cash. For him, cash is nothing but a product. He is dealing in cash only. So government says will not apply the provision of disallowance of section 40A3 to the money changer. Will not apply this disallowance provision to the money changer. Is that very, very clear? Yes or no? Okay. So with this we have covered section Rule 60D. Exceptional situations are already covered. So now we can move on to question number 11. Question number 11, I do not know how many of you have referred at home, but we can refer it right now. What I'll be doing is, I'll give you a 3 minutes time. Right now it is 7:59 in my watch. I'm giving you 3 minutes time up to 8:02. I'm giving you 3 minutes time. Kindly refer all these points, and on the left hand side margin you write whether it is allowed as deduction or it is disallowed. Whether it will be allowed or disallowed. Kindly write on the left hand side margin. I am giving you 3 minutes time. Quickly go through all the points. Wherever the disallowance is applicable, write how much amount is disallowed. And then we will have a small discussion on this. Let us proceed. Will the provisions of section 40 capital S 3 be attracted in the following cases? First of all, understand that if section 40 capital A 3 is attracted, what is going to happen? Disallowance will be attracted. Disallowance will be attracted means that amount will be added to your income. Let's move on to point number A. It says R makes a purchase of goods. R makes a purchase of goods of 30,000 on 14th February 21. So what is the transaction value? 30,000. So can I say expenditure is more than 10,000? Yes. I have purchased goods. I might have received the bill, and that bill amount is mentioning an amount of 30,000. So expenditure is more than 30,000. And he makes payment as under 15,000 is paid by a bearer check. So can I say amount exceeding 10,000 is paid by a bearer check? Yes. So that should have been disallowed. Point 1 should be disallowed. Now point 2, if you refer point 2, the date remains the same. Point 1, point 2, both the payments are made on the same date, and the first one is made by a bearer check, second one is made in cash. So what will happen? Even though cash payment is less than 10,000 now, that will be disallowed. Why so? Because when you are making payment for the same expense on the same day, if you make multiple payments, then you have to take up the aggregate amount. So you have to take up the aggregate amount, that is 15,000 plus 7,500, that is 22,500 amount should be taken. Both the payments are in non-compliance of this section. Both the payments are in non-compliance of this section. So you have to take up the aggregate and apply the provision. So what will be disallowed? 22,500 will be disallowed. Yes, is that very clear to you? 22,500 will be disallowed. And remaining payment of 7,500 is also made in cash, but it is made on a next date. It is made on 16th of February. So your expenditure is more than 10, but the payment of 16th February is not more than 10. So for this payment on 16th of February, deduction will be allowed. Deduction will be allowed. So 22,500 will be disallowed and 7,500 will be allowed. Is that very clear? Yes, point number A is very clear. Okay. Point B. R purchases a building for 10 lakhs and makes payment in cash. R purchases a building for 10 lakhs and makes payment in cash. See here, building is not stock in trade for Mr. R. Building might be a fixed asset for Mr. R. Anyway, when you purchase an asset, you don't get deduction, because section 37 subsection 1 says capital expenditure cannot be claimed as deduction. So while computing your income, if you have purchased an asset and you have made payment in cash, anyway you cannot claim deduction. Without even applying the provisions of section 40 capital A subsection 3, you are not going to get any deduction. So on a capital expenditure, 40A3 is not going to apply. Without applying the provisions of 40A3, capital expenditure will be disallowed. But if you refer to the definition of actual cost, section 43 subsection 1, there in the form of a note, we saw that if you have purchased an asset of more than 10,000 and the payment is made by account pay check, account pay bank draft, ECS, etc., then you will be allowed to add the actual cost of asset to the block of asset, thereby you will get the depreciation. And if you purchase an asset and you make payment of more than 10,000 in cash, then what we will do, we will not allow you to add that value of asset to the block of asset, thereby that actual cost will not be added to block of asset and you will not get any depreciation. So here in case of point number B, definitely section 40 capital A subsection 3 is not applicable, but section 43 subsection 1 definition of actual cost, there itself it is covered, saying that asset is purchased and payment is made in cash, then we will not allow you to add the value of asset to the block of asset, thereby you won't get any depreciation deduction. So here 40A3 is not attracted. Section 40A3 is not attracted. Section 40 capital A subsection 3 is not applicable in this transaction. Is that very clear? But yes, we will not allow you to add the value of asset to the block of asset, thereby you won't get any depreciation on this. Point 3, point C says R is a dealer in real estate. R is a dealer in real estate. He purchases building for 10 lakhs. He purchases building for 10 lakhs and makes payment in cash. So in this case, what do we say? Building is a stock in trade for him. Building is a stock in trade for him. In that case, purchase of building will be debited to his trading or profit and loss account, and he would claim deduction for that. And if he is making payment in cash for more than 10,000 rupees, definitely section 40A3 is attracted. Disallowance would apply. So in that case, here point number C, 40 capital A subsection 3 is applicable and deduction will be disallowed. Deduction will be disallowed. Yes, is that very clear? We have covered point number C as well. Let's move on to point number D. R makes an advance payment of 15,000 on 14 February 21. 15,000 is paid on 14 February 21. And this is nothing but an advance payment. So what entry you would pass? You would pass an entry, advance account debit to cash bank. This advance is paid in cash to G. So what entry you will pass? Advance to Mr. G account debit to cash account. Advance to Mr. G account debit to cash account. This is what is the entry that will be passed in the books of accounts. And this, in this entry, both the accounts which are involved are balance sheet accounts. Since they are balance sheet accounts, there is no question of claiming deduction. There is no question of claiming deduction. Further, it says this advance was made for purchase of goods and the delivery of goods is made on 20th March 2022. Delivery of goods has taken place on 20th March 2022. Means, can I say purchase account is going to get debited in the year 2021-22? Purchase account is going to debited in the year 21-22. If you recollect, such kind of situation was discussed with you now. For work primary deduction will be disallowed for the entire amount of 14,000 rupees. Point number F. R purchases goods in cash from his brother for 20,000 and the market value of these goods is 17,500. See, entire payment of 20,000 is made in cash and goods are also purchased from brother. So they are purchased from a relative. Section 48(2), 48(3) both are applicable. We have to apply which section first? Definitely you have to apply section 40 capital A subsection 2 first. So how much should be disallowed in 48(2)? How much should be disallowed in section 40 capital A subsection 2? 2,500 will be disallowed in section 40 capital A subsection 2. Thereafter, on the balance amount, you will apply section 40 capital A subsection 3. On the balance amount, you will apply section 40 capital A subsection 3. And how much will be disallowed in section 40 capital A subsection 3 is 17,500. This I have already discussed between example number 8 and example number 9. It is the same situation. Let us proceed further. Point number G. It says R purchases goods in cash from his brother for 11,000 whose market value is 9,000. So what will be disallowed in section 40 capital A subsection 2? 40 capital A subsection 2, 2,000 will be disallowed. 2,000 will be disallowed. What will be disallowed in 40 capital A subsection 3? Nothing will be disallowed. Why? Because the balance amount does not exceed 10,000 rupees. It is only 9,000. So 40 capital A 3 cannot be applied. 40 capital A 3 cannot be applied. Is that very, very clear? Yes. Let's move on to point number H. Point number H. See, I have explained you exceptional situation in Rule 6DD. The second last situation was talking about applicability of the provisions of section 40 capital A subsection 3 in case of an agent. So I told you that agent can be of two different categories. Either agent can be a dependent agent or he can be a independent agent. If the agent is a dependent agent, if at all disallowance is required to be applied, disallowance would apply to the principal, not to the agent. Whereas if the agent is a independent agent, then he is working for himself, disallowance would apply to the agent itself. Examiner sometimes uses the Hindi word in the examination. In Hindi, the word agent is called as Adati. It is called as Adati, or it is also called as Aratya. And dependent agent is called as Kacha Aratya. Independent agent is called as Pakka Aratya. So those words I have taken up here in point number H as well as point number I. So if you come across such words in the examination, you should not get confused. Kacha Aratya means an dependent agent, whereas Pakka Aratya means an independent agent. You can note down that. Now let's move on to point number H. Point H says R is a consignee agent. R is a consignee agent. If he is a consignee agent, means he is a dependent agent, and a dependent agent in Hindi is called as Kacha Aratya. So R is a consignee agent, Kacha Aratya, and he makes payment of 5 lakhs in cash for goods received by him for sale on commission or consignment basis. So who is making payment to whom? Consignee has received goods from consignor, and consignee agent is making payment in cash to the consignor. Do you believe this is a sale transaction? When the consignor is sending goods to consignor, when the consignor is sending goods to consignee and consignee is making payment to the consignor for the goods transferred, do you believe it is a sales entry? No, it is not a sales entry. It is just a transfer of goods entry. So it will not be debited to the profit and loss account. Since it is not going to get debited to the profit and loss account, the question of disallowance would not apply. Section 40 capital A subsection 3 will not get attracted, because just the goods are transferred by the consignor to the consignee, and whatever is the value of goods transferred, for that consignee is making payment to consignor. In that case, we are not going to apply the provisions of section 40 capital A 3, because the accounts involved in the entry would be balance sheet accounts. Yes, have you understood this point? Point number H. Point number H. Have you all understood very clearly? Yes. Let's move on to point number I. See, when I ask you a question, you should reply me by dropping a message. Point number I. R is a commission agent. R is a commission agent, Pakka Aratya. What do you mean by Pakka Aratya? He is an independent agent. He is working for himself. He is not working for the principal. R is a commission agent, Pakka Aratya, and makes purchases of goods in cash for 40,000 on his own account. On his own account means he is purchasing goods for himself. He is working for himself. Disallowance, if any, is required to be applied to him. He is purchasing goods on his own account and not on a commission basis. So he has made payment in cash and the value of the transaction is 40,000. So expenditure is more than 10,000, payment is also more than 10,000, and payment is made by cash. So yes, section 40 capital A subsection 3 will be attracted, and the entire amount of 40,000 will be disallowed. Entire amount of 40,000 will be disallowed. Yes, is that very, very clear? Let's move on to point number J. Point number J. R purchases goods in cash for 20,000 rupees from X. R is purchasing goods in cash for 20,000 rupees from X. X is a villager and R is making payment to Mr. X in his village where no banking facility is available. Do you recollect? If you make payment to a villager in a village and if that village is not served by any bank, then section 40 capital subsection 3 provisions are not attracted because this situation is covered by rule 60D, which is an exceptional situation. So in this case, section 40 capital A subsection 3 provisions are not attracted. Not attracted means what? Deduction will be allowed. Deduction will be allowed. Now let's move on to point number K. It says in the situation given in point J, what will be the answer? In the situation given in point J, what will be the answer if R makes payment to X, the villager, in a town where banking facility is available? See, the situation would be covered by the exception only when the payment is made to the villager, payment is made in a village and that village is not served by any bank. If you make payment to a villager in a town where the banking facility is available, then that villager should have opened the account. If he has not opened his bank account and you are making payment in cash, then the situation cannot be covered by rule 60D. Since it is not covered by the exceptional situation of rule 60D, provisions of section 40 capital 3 would be attracted, and since the amount of the transaction is how much? 20,000, entire amount will be disallowed. So here we say that provisions of section 40 capital 3 are attracted and 20,000 will be disallowed. 20,000 will be added to your income. Yes, is that very clear? Let's move on to the next point, point number L. R purchases goods on 25th March 21 for 20,000 and makes payment in cash for the entire amount on 10th April 21. So now if you look at the dates, 25th March 21, he has purchased goods on credit. So what entry he would pass in his books of accounts? Purchase account debit to creditors account. He'll pass an entry, purchase account debit to creditors account. So in the previous year 2021, deduction will be allowed to him. Why deduction will be allowed? Because in the previous year 2021, payment is not made at all. In the previous year 2021, payment is not made at all. Only the expenditure is recorded in the books of accounts. Since the payment is not made, you cannot check whether the payment is made by account, pay check, etc. So in the previous year 2021, while we compute his income, entire 25,000 will be allowed as deduction. But in the next year, that is previous year 21-22, payment is made, and you know that payment is made in cash. The value of the transaction is 25,000. So in the previous year 21-22, that 25,000 will be added to the income. 25,000 will be added to the income. Yes, is that very clear? Point number L. Okay, let's move on to next point. Next point is point number M. It is point number M. R makes a payment to a transporter. R makes a payment to a transporter. Do you recollect in case of transporter what is the limit to be applied? Yes, in case of transporter what is the limit which is required to be applied? It is not 10,000, it is 35,000. It is 35,000. So R makes a payment to a transporter on 11th November 20 for 30,000 rupees by bearer check. So a payment by bearer check, generally it is disallowed if it is more than 10,000 rupees. But since in case of a transporter, limit of 35,000 is required to be applied, here the payment of 30,000 will not be disallowed. Will not be disallowed. And further it says 38,000 payment is made in cash on 25th September 2020. So definitely this 38,000 should be disallowed because it is exceeding 35,000. So what will be disallowed? 30,000 will not be disallowed, but yes, 38,000 will be disallowed. Is that very, very clear? Now, if I change the situation, say for example, in this point number M, I am making slight change. Don't change in your textbook, I am just asking you a question. This 11th November 20 date. One payment is made on 11th November 20, one payment is made on 25th of September 20. If I make both the payments on the same date, 30,000 is paid by bearer check and 38,000 is paid in cash, and the date of payment is same. In that case, do you believe your answer would remain the same or it will change? If both the payments are made on the same date, do you believe your answer will change or it will remain the same? It will change. So how much will be disallowed? In that case, 30 plus 38. 30 plus 38. Entire 68,000 will be disallowed. Entire 68,000 will be disallowed. Have you understood this? Have you understood this modified situation? Okay. Now friends, let's move on to point number N. Point number N. R purchases goods worth 8,000 and 9,000 against two bills from G. So he has received how many bills? Two bills are received. One bill, the transaction value is 8,000. The other bill, the transaction value is 9,000. Do you want me to read the question further? Without reading the question further, we can say that provisions of section 40A3 are not attracted. Why? Why? Because the expenditure itself is not exceeding 10,000 rupees. Expenditure itself is not exceeding 10,000. So here he has made a payment of 17,000 in cash at one time. But the 17,000 is not the payment for one expense. It is payment for two expense. And you have to look at the payment for single expense. So in this case, condition 1 itself is not fulfilled. So provisions of section 40 capital A subsection 3 are not applicable. If provisions are not applicable, what is the consequence? Deduction will be allowed. Deduction will be allowed. Now let's move on to point number O. It says R purchases goods worth 15,000 from G against one bill. R purchases goods worth 15,000 from G against one bill. Means the amount of expenditure is more than 15,000. First condition is fulfilled. But makes payment in cash of 8,000 and 7,000 at different times on the same date. On the same date, two payments are made at different times. In that case, what will happen? Yes, if you are making multiple payments for the same expenditure, if you are making multiple payments, then we will take up the aggregate. To check the condition, we will take up the aggregate, and if the aggregate amount is more than 10,000, it will be disallowed. So here the aggregate amount is 15,000. Expenditure is 15,000. Payment in cash is also 15,000. So yes, definitely section 40A3 will be attracted. And what will be disallowed? 15,000 will be disallowed. 15,000 will be added to the income. Now friends, let's move on to the next point. That is point number P. R makes a payment of 20,000 as donation in cash to National Defence Fund. Tell me, will it be disallowed or it will be allowed? Or other way around, let me ask another question. Whether section 40 capital 3 is applicable or not applicable? No. I am changing my question. whether section 40 capital A subsection 3 is applicable or not applicable. Or not, first of all tell me, if you make the donation, if this payment would have been made by account paycheck, in which section you would have allowed the deduction? If this payment to the National Defense Fund would have been made by the account paycheck, in which section you would have allowed the deduction? Yes. Have you come across any section in the PGBP chapter which says that if you make donation to the government, deduction will be allowed? I have not taught any such section to you. So, from section 30 to section 38, from the range of section 30 to 38, which is the category of section which is allowing you deduction, we do not have any section which is allowing you deduction for the donation made to the government. If you give donation to the government, we don't have any section from the range of section 30 to 38 which will allow you deduction. You can't even claim deduction in section 37 subsection 1 general deduction, because one of the conditions in general deduction says that an expenditure should be a business expenditure. It should be a business expenditure. If you are making payment of donation to the government, it is not a business expenditure. It is an optional payment. Therefore, this donation will be disallowed anyway. Without applying the provisions of section 40 capital subsection 3, this donation is going to get disallowed because it is not an expenditure related to business. Now, those people who already know something about the income tax, they may think about the section 80G. In the chapter of deductions, there is section 80G which says that if you donate money to the government, to the National Defense Fund, that will be allowed as deduction. See, right now our objective is to compute the business income. So we should not think about the deduction chapter as of now. While computing the PGBP income, what would be the treatment? That is what we need to think. We need to think only about the PGBP chapter, not about the other chapters. So donation is not an expenditure relating to business. Therefore, deduction is going to get disallowed anyway without applying the provisions of 40A3. So here, without applying the provisions of section 40A3, anyway this amount is going to get disallowed because it is not an expenditure relating to business. Have you understood this very clearly? Yes? You can mark this point as an important point. See, when I started section 40A3, the first condition was, when I started section 40A3 with the help of this flow chart, the first condition which we checked was whether the deduction is allowed in the range of section 30 to 37. If deduction is allowed in the range of section 30 to 37, then only provisions of section 40 capital A subsection 3 be attracted. On the right hand side we said that if deduction is anyway not allowed, if the expenditure is not covered by section 32, 37, 40 capital A subsection 3 is not applicable. Anyway deduction will be disallowed. Without applying the provision of 48.3 itself, deduction will be disallowed. So the donation is covered in this flow chart by the right hand side. So the provisions of section 40 capital A subsection 3 are not attracted. Anyway deduction will be disallowed to you. Yes, have you understood this point very clearly? Yes or no? Okay. Let's move on to the last point then. Let's move on to the last point, point number Q. R makes a purchase of goods of 30,000. R makes a purchase of goods of 30,000 and makes payment of 22,000 by check and 7,500 in cash. See, in this point number Q, they have said that R has made a payment of 22,000 by check, but they have not clearly mentioned which check R has issued, whether he has issued the account pay check or whether he has issued the cross check. How he has made the payment? Has he made the payment by account pay check or has he made the payment by cross check? Because if he makes payment by cross check or a bearer check, deduction is going to get disallowed. It is not clearly mentioned. Therefore, in the absence of information, we would take an assumption that payment is made by way of account pay check. Payment is made by way of account pay check. Alternatively, see, you should give both the solutions. You should write that in the absence of information with respect to payment is made by using which check, it is presumed that payment is made by way of account pay check, therefore nothing is disallowed. Then you can write alternatively, if the payment is made by way of bearer check or cross check, then amount of 22,500 will be disallowed. This is the way you should write the answer. You should be taking a diplomatic stand in your answer because examiner has not given you the complete information. So we take an assumption that this 20,000 is payment is made by account pay check. Account pay check. So in that case, nothing will be disallowed. And the 7,500 is cash, but this amount is less than 10,000. So in that case also nothing is disallowed. So entire 30,000 is allowed as deduction. Entire 30,000 is allowed as deduction. Yes. So one of the students have messaged that, sir, there is no mention about whether the payment is done on the same day or not. So if nothing is mentioned, once again we have to take an assumption that the payment is also made on the same date. On the assumption that the payment is made on the same day, we are answering this question. Yes. So with this we have completed question number 11 and the discussion with respect to the provision of section 40 capital A subsection 3 comes to an end. So make the judgment and tell me how much amount I should pay to you, so that you will maintain a gratuity fund on my behalf, and whenever the employee retires, payment of gratuity will be made to the employee out of the gratuity fund maintained by the LIC on my behalf. So I have entered into an agreement with the LIC saying that LIC will take the data of my employees, means there are how many employees, what is the date of birth of an employee, which employee is going to retire on which date, what is the salary of employee, all this data will be provided to the LIC officers. You might have learned something called as actuarial valuation, or you might have heard something about the actuarial valuation. So LIC will appoint the actuary. Actuary will take up this data, and based on this, actuarial officer will give some amount, will ascertain some amount, and that amount I will be required to pay to LIC of India every year. So in this case, I will be making some payment to LIC every year. This payment I would definitely debit to my profit and loss account. So every year I will be making certain payment to LIC. Means it is as good as I am making investment. So it is similar to sinking fund investment, wherein I'll be making investment with the LIC. So LIC has got money. LIC will invest this money somewhere. From that they would earn some amount of return, and whenever my employee retires, I am not going to pay gratuity to my employee. Gratuity will be paid from the gratuity fund which is maintained by the LIC on my behalf. What is the consequence of this? As a result of maintaining this fund, in the year of retirement, there will not be any cash outflow from my side. My bank account will not get affected. So my business will not get affected. My working capital cycle will not be disturbed. So the question is, none of my employees have retired. My employees are not retired, but I am making payment to LIC. Can I claim deduction for that? Answer is yes, because even though employee is not retired, there is a actual cash outflow. There is a actual cash outflow from the business. So yes, this deduction will be allowed. So here I have given you the reasoning. Employee is not retired, but amount is contributed to the approved gratuity fund, and therefore there is a actual cash outflow, and since there is a actual cash outflow, this will be allowed as deduction. This will be allowed as deduction. See, even if the payment is not made in the current year to the LIC, payment is required to be made in a short span of time. That payment will be a current liability for me. So any provision is made for payment of contribution to approved gratuity fund, then that amount will be allowed to me as deduction. Yes, have you understood this point number A very clearly? Point number A, have you understood? So in very simple terms, we can say that payment to an approved gratuity fund will be allowed as deduction. Payment to an approved gratuity fund will be allowed as deduction. Now, let's move on to second situation, that is situation B. Now, say for example, I have not gone to LIC, I have not asked LIC to maintain any fund on my behalf. So in that case, if employee retires, I will have to pay gratuity to him from my own pocket, because I have not maintained any fund, I have not made any investment in the past. Now for example, I have not maintained any fund, so gratuity is required to be paid to the employee from my own pocket. Now say for example, my employee is already retired. My employee is already retired. Say for example, employee is retired in the month of March. Since employee is retired, I have to pay him gratuity. The liability to pay gratuity has already arisen. Liability to pay gratuity has already arisen because my employee is retired. He retired in the month of March. He came to me, sir, pay me gratuity. I told him, right now I don't have money. I'll arrange the funds and I'll definitely pay you within 60 days. So you come to me in the month of April. So 30th April, I'll pay you gratuity. So employee is retired in the month of March. I have not maintained any gratuity fund. Since employee is retired, my liability to pay gratuity has arisen, and I have promised him that I'll be making payment in the month of April. Now my question is, you are going to make your financials for the year ended 31st March. You have not paid gratuity to your employee, but he is already retired. The liability to pay gratuity has already arisen. If you are maintaining your books of accounts by following mercantile system, don't you feel that you should create a provision? Definitely you should create a provision. So you will create a provision for the gratuity for which the liability has already arisen because employee is already retired. In that case, should we allow you deduction for the provision? Government says, yes, we will allow deduction even for the provision. Why? Because the liability to pay the gratuity has already arisen. Since the liability has already arisen, definitely payment will be made in a short span of time. So it will form part of my current liability as of now. Therefore, government says, since employee is retired, we will allow you deduction even if you are making a provision. So point B says, provision is made for payment of gratuity. Gratuity is required to be paid in say 50-60 days time. At the end of the year, I have created a provision. So this is the provision which is made for the payment of gratuity that has become payable during the year. In this case, employee is retired, gratuity has become payable. There is no actual cash outflow as of now, but there is a expected cash outflow in a short span of time. There is a expected cash outflow in a short span of time. So government says this will be allowed to you as deduction. This will be allowed to you as deduction. So in situation A, there is an actual cash outflow. In situation B, as of now there is no actual cash outflow, but cash outflow is expected in a very near term in 1 or 2 months because employee is already retired. So liability to pay gratuity has arisen. Therefore, in situation A as well as B, government says deduction will be allowed to you. Now let's move on to the last situation, that is situation C. Situation C says, provision is made for gratuity payable to employees in future. I have created a provision for what? Gratuity which is payable in future. In future means at the time of retirement. Now question is, do you believe that there is a actual cash outflow right now? If I pass an entry for provision, what entry I'll pass? Profit and loss account debit to provision for gratuity. By passing this entry, do you believe that there is an actual cash outflow? Definitely not. There is no actual cash outflow. Number 2, do you believe that employee is retired? No, employee is not retired. He will retire in future. So liability to pay gratuity has also not arisen as of now. So as of now, there is no actual cash outflow. There is no expected cash outflow in a short span of time. Employee is not retired. Liability to pay gratuity has not arisen. I have just passed an entry based on some estimate. So government says, in this case, we are not going to give you any deduction. Deduction will not be allowed to you. So situation C, employee is not retired and provision is made on an estimated basis. This is an estimated amount. For estimated amount, provision is made. There is no expected cash outflow in the near term. Therefore, this provision will be totally disallowed. This provision will be totally disallowed. So with this, section 40A7 is over. But before I move on to some other very small section, I would like to summarize this 40A7 for you. I would like to summarize this for you. Say for example, in the examination, in the profit and loss account debit side, it is written to provision for gratuity. It is written to provision for gratuity. Now, Sarvana has asked me a question. Sir, what is the difference between section 36 subsection 1 clause 5 and section 40 capital A subsection 7? See, Sarvana, 31, section 36, subsection 1, clause 5 is a deduction for allowing, is a section for allowing the deduction. Section 36, subsection 1, clause 5 is a section for allowing the deduction, whereas section 40, capital A, subsection 7 is a section for disallowing the deduction. Both the section, they belong to two separate categories. If you recollect in the chapter of income from house property, now interest on loan was allowed as deduction with section 24 clause B. So section 24 clause B was a section which was allowing you deduction. But we also had one section, section 25, which said that if you make payment of interest outside India, then deduction will be allowed only if two conditions are fulfilled. Number one, if the adequate TDS is deducted and there is a representative of that non-resident person in India. So section 24 clause B belonged to a category of section which was allowing deduction, and section 25 belonged to a category of section which was disallowing you deduction. So section 40 capital A subsection 7 is simplified by me for you, saying that provision will be disallowed. Section 40 capital A subsection 7 simply says that provision will be disallowed. And section 36 subsection 1 clause 5 says if you have made payment to the approved gratuity fund, then deduction will be allowed. Yes, have you understood the difference between these two sections? Yes, Sarvana? Okay, okay. So both the sections actually belong to two separate categories. One section is allowing deduction, the other section is restricting the deduction or putting the conditions. Now now as of now it is already 8:57. So I think I will not be in a position to start any other section right now. So we'll have a break, and before that I will summarize 40A7 for you. In the examination 40A7, how the adjustment would appear, that is what I'll summarize for you. Say for example, a profit and loss account is given to in the question, and debit side of profit and loss account, the entry is appearing to provision for gratuity. Entry is appearing to provision for gratuity, and nothing is mentioned in the adjustment about the gratuity. Nothing is mentioned in the adjustment about the gratuity. Profit and loss account debit side, it says to provision for gratuity. In that case, we'll say that employee might not have retired. This provision is just an estimated amount. That amount should be disallowed while computing the income. That amount should be disallowed. This is one situation. Another situation is on the profit and loss account debit side, they have written to provision for gratuity, and in the adjustment they are saying you that employee is retired. In adjustment they are saying you that employee is retired, and profit and loss account debit side they are saying to provision for gratuity. What do you mean by that? This provision is created on an estimated basis, or this provision might have been created for the actual liability which has already arisen due to the retirement of an employee? Definitely provision is created for the actual liability because employee is already retired. So in this case deduction will be allowed to you for the expenditure. This is the second situation. Now third point says, first of all, have you understood these two situations? The first situation, only profit and loss account is debited with an estimated amount, employee is not retired, so deduction will be disallowed. Second situation, also provision is created, but in the adjustment they are saying that employee is retired, so provision is created for the actual liability, deduction will be allowed for that. For that provision, deduction will be allowed. Now let's move on to the third situation. In the third situation, profit and loss account debit side, they say that contribution to approved gratuity fund. Profit and loss account debit side, it appears contribution to approved gratuity fund. In that case, definitely there is a actual cash outflow. There is a actual cash outflow. Deduction should be allowed. Or on the profit and loss account debit side, it appears to provision for payment to approved gratuity fund. To provision for payment to approved gratuity fund. In that case also deduction will be allowed, because provision is created for the payment to be made in a short span of time. Provision is created for a payment to be made in a short span of time. Let me move on to the last situation. Profit and loss account debit side. It says contribution to unapproved gratuity fund. It says contribution to unapproved gratuity fund. So if you make any contribution to unapproved funds, deduction will not be allowed to you. Deduction will not be allowed. It will be totally disallowed. Is that very, very clear? Yes, have you understood all the situations? I have summarized section 40 capital A subsection for you. 40 capital A subsection 7 is summarized for you. Have you understood very clearly? Before the break, we have completed section 40 capital A subsection 3, exceptional situation which are covered by rule 60D. We also covered up question number 11, and we also discussed the section 40 capital A subsection 7, which spoke about provision for gratuity. Now we move on to a very small section, that is section 43B. We are moving on to a very small section 43B. See, section 43B gives you the list of expenditure for which deduction is allowed on payment basis. Everywhere in each of the head of income, there are certain expenses for which deduction is allowed on payment basis. For example, you refer to the chapter of income from house property, deduction for municipal tax is allowed on payment basis. Deduction for municipal tax is allowed on payment basis. Similarly, here in the chapter of PGBP, we have list of certain expenses for which deduction will be allowed on payment basis. So friends, let's move on to this section 43B, which gives you the list of certain expenses for which deduction will be allowed on payment basis. This entire page, that is page number 143, this entire section 43B is presented here in a tabular form. 40A9 we will discuss. 40A9, don't worry about that. I will cover up all the sections, don't worry about that. Everything will be covered properly. See, for May 21 students, I have a clear intention to cover all the 5 heads of income as well as deduction in very much detail. It will be covered in very much detail. Other chapters, if we don't have time, see, up to 5th of May, I need to cover up the syllabus for you. But from today onwards up to 5th of May, the number of hours which are available with me are less as compared to what number of hours are required. But still I am planning to complete 5 heads of income as well as deduction chapter in live classroom, face-to-face class, or maybe live online. And some chapters like which are less important, like return of income assessment, set off clubbing, etc. We can think of record the lecture and give it to you. We are thinking about that. Very small, few chapters, around 15 to 20 hours. 15 to 20 hours. I was thinking that if I can record in advance and give it to you, around only 15 to 20 hours. Then if you can watch it at home in the evening, late evening, then that would be that would help us to complete the syllabus by 5th of May. I'm just talking about the May 21 students. But besides that, don't worry, I'll be covering everything in detail. I'll be solving questions as well. So every provision will be covered in detail. Right now we are moving on to page number 144. Here in point number G, section 43B is summarized for you. Section 43B is summarized. First of all, understand that section 43B is from the point of view of payer. It is from the point of view of payer. So here SSC is a payer. SSC is making a payment to the payee. SSC is making payment to the payee. Who all are payees? Number one, government is a payee. When government is paying, what is payable to government? Tax, duty, cess, etc. is payable to the government. Number 2, financial institution, scheduled bank, cooperative bank or non-banking financial company is a payee. An SSE has taken loan or advance or borrowing from these institutions. So SSE has to pay interest on loan, interest on advance to them. So when the payee is a financial institution, scheduled bank, cooperative bank, non-banking financing company, in that case the nature of payment is either interest on loan, interest on advance or interest on borrowings. Third payee is employee. Third payee is employee. And there are three different payments with respect to employee. Number 1, bonus commission to employee. Bonus commission to employee. Leave salary to employee. And number 3, employer's contribution to provident fund. In provident fund, employer employee both will have to contribute. There is something called as leave salary also, that we will discuss in detail when we move on to the next chapter, that is income from salaries. But there are three payments which are done to employee or which are done for the benefit of employee. Those are employer's contribution to provident fund, bonus commission to employee and leave salary. These three payments are connected to employee. Number 4, pay is Indian Railways. Number 4, pay is Indian Railways. For example, you are having a factory in Gujarat. You are having a factory in Gujarat in which you are manufacturing the goods, but those goods are sold throughout the country. So how can you send the goods from Gujarat to different parts of the country? Number 1, you can send it by aircraft. It will be very much costly for you. Number 2, you can send it by railways. Or number 3, you can send it by roadways. Railways would be, freight would be much cheaper as compared to roadways. So if you are using the railway wagons, you have taken entire one train on rent from the government and you are using the railway wagons and you are paying rent to the government for usage of railway wagons, or maybe we can say you are paying freight to the Indian Railways for using the assets of the Indian Railways. In that case, pay is Indian Railway and the payment is made for use of railway assets. Payment is made for use of railway assets. Now, Government of India in section 43B says that when the payee is government, bank, financial institution, employee and Indian Railways, and these are the nature of payment, in that case we will allow you deduction only on actual payment basis. We will allow you deduction only on actual payment basis. In other words, see, when we started this chapter, we started with section 145 saying that income under that PGBP will be calculated based on the method of accounting followed by SSE. If SSE is following cash system of accounting, anyway, every expenditure deduction is allowed on payment basis only. Therefore, by default, we can say that section 43B is applicable only in case of those SSEs who are following mercantile system of accounting. So those SSEs who are following mercantile system of accounting, to them all the expenditure deduction is allowed on accrual basis, but this expenditure which is covered by section 43B will be allowed on payment basis. there is a due date for filing this income tax return. There is a due date. This due date is either 31st July. This due date is either 31st July or it is 31st October. Either it is 31st July or it is 31st October. See, up to last year, this date was 30th September. This date was 30th September. Now it is extended by the government. So the new date which government has given is 31st of October. So if you want to file the income tax return for the previous year 2021, you will have to file the income tax return, the assessment at 21-22, and the due date of filing return would be 31st July. Either it will be 31st July or it will be 31st October. Now, this point is relevant when we discuss section 43B. This point is relevant when we discuss section 43B. So here in section 43B, we said that certain expenditure is allowed as deduction on payment basis. Now the question is, till what time payment should be made? Payment should be made up to what time? So we say that these amounts are required to be paid up to the end of the year. What is your previous year? 2021. So what is the end of the year? 31st March 21. 31st March 21 is the end of the year. So either you make the payment by 31st March 2021 or you make the payment up to the due date of filing income tax return, which is given in section 139 subsection 1. So government is telling you, you make the payment of these expenses up to the end of the year, that is 31st of March. If at all you are unable to make the payment up to 31st of March, we will give you one more opportunity. We will give you one more opportunity to make the payment. And that opportunity is till you file your income tax return, till that date you make the payment. Till that date you make the payment. If you have made the payment either up to the end of the year or up to the due date of filing income tax return, that is 31st July or 31st October, whichever date is applicable to you, then deduction will be allowed for the expenditure while computing income in the current year itself. Then deduction will be allowed for the expenditure while computing income of the current year. That is, deduction will be allowed while you compute the income of the previous year 2021. What is another possibility? Another possibility is this expenditure you have paid after the due date of filing income tax return. So what is the due date of filing return? Either it can be 31st July or it can be 31st October. If you have made the actual payment either after 31st July or 31st October, whichever due date is applicable to you, in that case, deduction will be disallowed while computing income of current year. In other words, while you compute the income of the previous year 2021, expenditure will be disallowed to you. Expenditure will be disallowed to you. And government says this is not a permanent disallowance. We are disallowing you the expenditure on a temporary basis. Till what time? Till you make the actual payment. So for example, in your case, 31st October is the due date of filing return. For example, you did not make the payment up to 31st October. So what is the consequence? While you compute the income for the previous year 2021, expenditure will be disallowed. Now say for example, you paid the expenditure in the month of December. Then while you compute the income of the next financial year, that is next previous year. What is next previous year? Previous year 21-22. Previous year 21-22. Since you have made the payment after the due date of filing return, that expenditure will be disallowed while you compute the income of the previous year 2021, and that same expenditure will be allowed to you as deduction while you compute your income for the previous year 21-22 and the corresponding assessment year 22-23. Tell me, have you understood this? Yes, have you all understood this? So if the amount is paid after the due date of filing return, deduction will be allowed in the year in which the amount is paid. Right now, deduction will be disallowed. In the current year, deduction will be disallowed. It will be allowed in the year in which the payment is made. So this is section 43B, which gives you deduction for the expenditure on payment basis. Payment is required to be made either up to the end of the year or up to the due date of filing return. If it is made, deduction will be allowed while computing income of the current year itself. If the payment is made after the due date of filing return, then the deduction will be disallowed in the current year and deduction will be allowed in the year in which the actual payment is made. Now friends, I have already told you that page number 143 you can refer on your own. This is a theory, entire theory kind of thing. That same thing is summarized there in point number G, it was summarized. So I have explained you this provision from the flow chart. See, point 1 says section 43B is having overriding effect on the Income Tax Act. Means section 43B should be given the highest importance. While you read section 43B, all the provisions of the Income Tax Act should be kept aside. Only 43B should be referred. So while you refer to section 43B, other provisions of the Income Tax Act, you should not try to connect those provisions to the 43B. 43B is independent. It is a high priority section, and priority should be given to section 43B. Means while you read section 43B, other sections should be totally ignored. It is having an overriding impact. Certain expenses are deductible on payment basis, and this section is applicable to SSCs following mercantile system of accounting. Information given in this table is nothing but different nature of payments and up to what date you are required to make the payment. This we have already discussed. Now let's move on to certain important points. In important points, I am not going to discuss point number D, E and F, because it is just a definition of what is non-banking financing company, what is the meaning of systematically important non-deposit taking NBFC, and what is the meaning of deposit taking NBFC. These are the definitions which are taken from RBI Act 1934. So these are not relevant when it comes to your examination with respect to income tax subject. Just only for the purpose of formality I have given those definitions here. But yes, point number A, B and C are important. Point number A, B and C are important. We'll try to cover up those points. Out of point number A, B and C also, point number B and C, it is a case law which is generally discussed at CA final level, but still I will discuss the facts with you, so that if you come across such a point in the examination, you should be in a comfortable position to answer. First of all, let us move on to point number A. Conversion of outstanding interest into loan does not amount to actual payment, therefore deduction is not allowed. What is the meaning? Say for example, you have taken a bank loan. You have taken a bank loan of say 10 crores and the rate of interest is 10% per annum. So what is the amount of interest you are supposed to pay to the bank? You are supposed to make a payment of interest of 1 crore to the bank. Now say for example, for whatever reason you were facing financial crunch, you were facing financial difficulties, you did not make the payment. This interest is outstanding. Can you claim deduction? Answer is no, deduction is not allowed, because deduction is allowed only on payment basis. Deduction is allowed only on payment basis. But now what has happened is, say for example, this was the story of previous year 1920. Interest was outstanding, payment was not made, therefore deduction for this 1 crore interest which is debited to your profit and loss account will be disallowed. Now say for example, it is previous year 2021, bank is asking you to pay the interest. The last year, previous year 1920, you did not pay the interest, so that interest is outstanding. Bank is asking you to pay the interest for the 1920, and you are saying that right now I don't have funds, I don't have money, I am facing financial difficulties because of this COVID, etc. So bank is giving you option that we will convert your outstanding interest of 1 crore into loan. So you said that yes, I am ready to accept this. You convert my interest into loan. So your original bank loan which was taken was for 10 crores and then 1 crore interest is added to the loan. So your outstanding loan, now it will be 11 crores. So you will transfer the interest balance to the loan account now. Interest was a liability for you, interest was payable, it was not paid. So that interest would appear on the liability side of your balance sheet. And now you are transferring your outstanding interest to bank loan. So you will pass an entry, outstanding interest account debit to bank loan account. Thereby your outstanding interest has got converted into a bank loan. Now the question is, this conversion of interest into loan, will you consider this as actual payment? Is it actual payment? Because as an SSC you will say that my outstanding interest account is showing a nil balance. Entire amount payment is done, because outstanding interest ledger account is showing a zero balance. So government says no, this is not an actual payment. This is not a actual payment. This will not be considered to be actual payment. Therefore, deduction will not be allowed. Deduction will not be allowed. In other words, when you convert your outstanding interest into loan, that won't be considered as actual payment for the purpose of section 43B. Even though you are not required to make the payment of interest now, but you are required to make the payment of loan of 11 crores now. That 11 crore includes an interest. So your interest is not paid. It is just that you have passed a book entry by doing some arrangement with the bank. Thereby your outstanding interest has turned out to be zero. That doesn't tantamount to actual payment. Therefore we say that deduction will not be allowed for the interest. Deduction will not be allowed for this 1 crore interest. Have you understood this? Yes? Shall I proceed? Okay. So point A is done. Point A says conversion of outstanding interest into loan does not amount to actual payment, therefore deduction is not allowed. Therefore deduction is not allowed. One more point I wanted to explain you. Before I explain you point number B and C, I would like you to take to section 36. In that case, you can't write that wealth tax is already scrapped, so this wealth tax is appearing here in profit and loss account, question is wrong. That way you cannot give the answer. So I am taking up the point of wealth tax also. Here I am saying that income tax and wealth tax, these two direct taxes, they are not considered as expenditure. They are not considered as an expenditure, they are considered as appropriation of profit. They are considered as appropriation of profit. Friends, if you remember, somewhere in 11th standard or 12th standard, when you learn the chapter of journal for the first time in your life, the transaction would appear in the question income tax paid. Income tax paid. At that point of time, what journal entry used to pass was drawings account debit to bank account. You did not pass the entry income tax account debit to bank account. You used to pass an entry drawings account debit to bank account, because this income tax should not be considered as an expenditure. It is an appropriation of profit. It is an appropriation of profit. An appropriation of profit should not be debited to your profit and loss account, and deduction should not be allowed for that. So income tax, wealth tax, both are considered as appropriation of profit. They are not considered as charge against profit. So they are not allowed as deduction. We have a separate section for that also. Section 40 clause A subclause 2 and section 40 clause A subclause 2A. This section says that income tax and wealth tax, anyway deduction is not allowed. Anyway deduction is not allowed. So whenever income tax and wealth tax would appear on the debit side of profit and loss account, you would disallow that expenditure. You will disallow that amount because it should not be considered as an expenditure. It should be considered as an appropriation of profit. On the other hand, indirect taxes like goods and service tax, GST, custom duty, etc. Those indirect taxes are on goods, are levied either on goods or on services, and they are allowed as deduction. They are allowed as deduction. They are allowed as deduction which section? They are allowed as deduction in section 37 subsection 1. They are allowed as deduction in section 37 subsection 1, but at the same time, if you refer section 43B, you say that when the pay is government, and when the nature of payment is tax or duty, deduction will be allowed subject to section 43B, means deduction will be allowed only on actual payment. So these other taxes, indirect taxes, they are allowed as deduction, but they are allowed as deduction subject to section 43B. Since they are allowed as deduction subject to 43B, if the payment is made, deduction will be allowed. If the taxes are outstanding, deduction will not be allowed. So I am summarizing this for you. Income tax, wealth tax, deduction is not allowed, irrespective of whether the payment is made or it is outstanding, because they are not considered as an expenditure. In section 43B, 2 points were remaining. Let us discuss those two points, point number B and point number C. Now listen to me very carefully. In Mewar Motors versus CIT Rajasthan High Court observed that if you have not paid GST on time, if you have not paid GST to the government on time, then you will be required to pay interest on GST. You will be required to pay interest on GST to the GST department. Now the question is, this interest paid to the GST department, should it be considered as an interest expenditure or should it be considered as a tax only? Because this interest, generally we pay interest to the bank, but this time, since you have not paid the taxes on time, you have paid taxes after the due date, government will levy the interest, so you are paying interest to the government. Should that also be considered as a payment to the government, and should we apply section 43B to it? Answer is yes. Here in Mewar Motors Limited, Rajasthan High Court said that interest on tax would take the nature of that tax only. Means if you are paying interest to the central government on the outstanding income tax, that interest would take form of income tax. If you are paying interest to the government on the GST amount, that interest on GST would be considered as a GST only. So interest on taxes would take the form of that tax only. So interest on income tax would be considered as payment of income tax, and interest on GST would be considered as payment of GST. And you know that income tax is not allowed as deduction. Therefore, interest on income tax should also not be allowed as deduction. On the other hand, GST is allowed as deduction subject to section 43B, that is payment basis. So interest on then also he will not make the payment on time. So we don't have the confidence on the SSC. You kindly ask the SSC either to make the payment or to provide some bank guarantee. Bank guarantee means if you don't make the payment, bank will be asked to make payment on your behalf. So you have to get the bank guarantee. So you are fighting a case with the GST department, and the court orders that we will allow the proceedings to move further only when you pay the tax as of now or you submit the bank guarantee. So say for example, the disputed amount of tax was 5 lakh rupees. 5 lakh amount is a disputed amount of tax. There is a dispute whether this is required to be paid or not required to be paid. So there is a dispute. This is a disputed amount. On the conclusion of the case, certainty will come whether this is payable or not. But for the time being, court has asked you to submit the bank guarantee. So you have gone to the bank, you have got the bank guarantee for 5 lakh rupees, and you are submitting this bank guarantee copy to the court. Do you believe that giving a bank guarantee amounts to actual payment of tax? Answer is no. Giving a bank guarantee does not tantamount to actual payment of tax. Bank guarantee is given only for the purpose of security to the revenue, that if you lose the case, the department will not have to run behind you for money. They can just liquidate the bank guarantee and get the funds. So when you provide a bank guarantee for the disputed amount of tax, that doesn't amount to actual payment of tax. That doesn't amount to actual payment. So bank guarantee provided should not be considered as an expenditure. It should not be allowed as deduction. So bank guarantee given by company towards the disputed tax liability does not amount to actual payment, and therefore this will not be allowed as deduction. Have you understood this point number B and C very clearly? Yes? Point A, B, C. Have you understood all these 3 points? Okay. So with this section 43B is over. With this section 43B is over. Now actually I wanted to go on to a practical question. See, if you refer to page 146, section 41 subsection 1 is over. Section 41 subsection 2, 41 subsection 3, 41 subsection 4, all these sections are over. All these sections are over. Now, actually I wanted to move on to question number 12, which is a comprehensive question. But before I move on to that, I would like to discuss 2-3 small sections. Not small, bigger ones. I would like to discuss 3 sections, and we are going to discuss 3 sections simultaneously. 3 sections will be discussing simultaneously. These 3 sections are section 40 clause A subclause 1. Second one is section 40 clause A subclause 1A, and the third one is section 40 clause A subclause 3. So section 40 clause A subclause 1, subclause 1A and subclause 3. These 3 sections we are going to discuss. Now, I will give you the background of this section before actually moving on to the discussion of this section. Say for example, I am doing my business. I am doing a business. So there are lot of persons with whom I am dealing. There are a lot of persons with whom I am dealing. These persons, they may provide me goods, they may provide me services, or they may provide me certain facilities, and I am supposed to make a payment to them for this goods, services and facilities. For these goods, services and not understood. B point of section 43B. What point B says? There is a disputed tax liability. What do you mean by disputed tax liability? Whether you are supposed to pay that tax or whether you are not supposed to pay that tax, there is a dispute. There is a dispute between you and the department. Which department? GST department. So there is a dispute as to whether the tax is payable on a particular transaction or it is not payable on a particular transaction. So there is a fight going on between you and the GST department. If you lose the case, you will have to pay the GST. If you win the case, you will not have to pay the GST. But the GST department says, in the court of law, the officers of the GST department say that, sir, we do not have the confidence on the taxpayer, saying that even if he loses the case now, he will not pay GST on time. So we don't have confidence on the taxpayer, we don't have confidence on the SSE. So you do one thing, ask the SSE to provide a bank guarantee. Now say for example, disputed amount of tax is 5 lakh rupees. Now the case is going on in the court, but the proceedings are stopped and the court has asked you, first of all you provide the bank guarantee of 5 lakh rupees, then only proceedings will move further. So what you have to do? You have to go to a bank and you have to get the bank guarantee for the disputed amount of tax of 5 lakh rupees. And this bank guarantee you have to submit to the court. The moment you submit this bank guarantee to the court, then the proceedings will move further and the case will be decided and the decision will be given. So my question to you is, when you provide a bank guarantee to the court, is it an actual payment of tax? When you provide a bank guarantee to the court, is it an actual payment of tax? No, because the tax amount itself is in dispute. So whether you are supposed to pay or not supposed to pay is not yet decided. It will be decided on the conclusion of the case. Right now, you have given the bank guarantee for the security of the department, that if you lose the case, department will not have to run behind you to collect the tax. So you have just provided the bank guarantee. Providing the bank guarantee does not amount to actual payment of tax. Therefore, we say that deduction will not be allowed. Deduction for payment of tax is allowed on actual payment, na? So when you provide the bank guarantee, it is not an actual payment. Since it is not an actual payment, deduction will not be allowed. Yes, have you understood this one? Yes or no? Yes, okay. So once again, I move back to those three sections, section 40A clause 1, 40A clause 1A and 40A clause 3. Three sections I need to discuss with you. Simultaneously, we will be discussing three sections so that we have a comparative idea as to which section is applicable in which situation. For that, first of all, I make you understand the background of the section and then we'll move on to discuss the section. Say for example, I am doing my business, so I am transacting with other persons. I am having lot of transactions, either for purchase of goods or for purchase of services or for getting certain facilities. So when I get the goods, services, facilities, I am definitely required to make the payment for these goods, payment for the services and payment for the facilities. The amount which I pay, it is an income for the other person. That amount is an income for the other person, and for me, that amount is an expenditure. That amount is an expenditure. Since it is an expenditure, I will debit my profit and loss account. Profit and loss account will be debited. I will debit my profit and loss account and I will ask for deduction. I will debit my profit and loss account and I will ask for deduction. Government says deduction will be allowed to you for this expense. For this expense, we will allow you deduction. For that, you have to do two things. You have to do two things. Number one, you have to deduct tax. You have to deduct tax. Deduct tax means nothing but TDS. TDS. See, the amount which I pay to others is an expenditure for me, but it is income for others. So while I pay income to them, government has given me the duty, government has assigned a duty on me, saying that I should deduct the tax. So my first job is to deduct the tax, and whatever tax I have deducted, it is not my tax, it is the tax of these other persons. So I need to pay this tax to the government on their behalf. So I need to pay this tax. So government is expecting me to do two things when I pay the income to other persons. Instead of saying that I am incurring expense, I am saying that I am paying income, the other person is receiving income. I am a payer of income, they are receiver of income. For me, it is an expenditure. I will debit to my profit and loss account. I will claim deduction for it. And government says deduction will be allowed. Deduction will be allowed subject to two conditions. What is the first condition? I should deduct the adequate amount of tax. I should deduct the adequate amount of tax. And number two, this tax I should pay to the government. This tax I should pay to the government. Ishwar, what you have written, I do not understand. You don't drop the messages in Tamil here. Ishwar, to whom you are talking? I don't understand Tamil. So if you want to drop messages in Tamil, you should send these messages to Ishwar only. God, he will explain me. Oh, by mistake. Not an issue. Listen to me very carefully now. Deduction for the expenditure will be allowed to you provided two conditions are satisfied. You are deducting the TDS and that amount of TDS you are paying to the government. This is one possibility. Government has assigned you two responsibilities: deduct the tax and pay the tax. If you have performed both the duties, then deduction will be allowed for the expenditure. Deduction will be allowed for the expenditure. What if you forget to deduct the tax? If you forget to deduct the tax, you have not deducted the tax, then what? Then deduction will not be allowed for the expenditure. See, if you forget to deduct the tax, definitely you are not going to pay that tax from your own pocket. Generally, you will not pay from your own pocket. You have forgot to deduct the tax, so you have non-complied with the section. There is a default from your side. You have not deducted the tax. In that case, deduction for the expenditure will be disallowed. Deduction for expenditure will be disallowed. Third possibility is you have deducted the tax, but you have not paid this tax to the government. You have not paid this tax to the government. In this case also, deduction will be disallowed for the expenditure. Expenditure will not be allowed to as deduction. So if you want to claim deduction for the expenditure, what you have to do? You have to deduct the TDS, you have to deduct the tax, and this tax you should pay to the government. See, this section is similar to section 25 of IFSP, which said that if you are paying interest outside India, deduct the tax. So here we are saying that you deduct the tax and you pay tax to the government. So now friends, let's move on to section 40A, subclause 1, subclause 1A and subclause 3 at the same time. Simultaneously we will be discussing, we will try to understand what is the difference between these three sections. Section 40A subclause 1 is applicable when the payment is made outside India or in India to a foreign company or a non-resident person. Payment is made to whom? Payment is made to a foreign company or non-resident person. So, applicability of section we are discussing. Section 40 clause A subclause 1 is applicable when you are making payment to either a foreign company or to a non-resident person. Section 40 clause A subclause 1A is applicable when the payment is made to resident persons. Payment is made to a resident person. So if you are making payment to a foreign company or non-resident person, section 40A subclause 1 will be applicable. If you are making payment to a resident person, 40A subclause 1A will be applicable. And the last is 40A subclause 3. 40A subclause 3. Payments are made to a non-resident person. Payment is made to a non-resident person. Now you may feel that the applicability of subclause 3 is automatically covered in subclause 1 only. Why there was a need to make a separate section? Because you are in 40A subclause 3, we are saying that when the payment is made to a non-resident person, this section would be applicable. Same is the applicability of 40A subclause 1. There also it is written foreign company or non-resident person. So why there was a need to make two different sections? The answer is 40A subclause 1 is applicable for different nature of payment and 40A subclause 3 is applicable for different nature of payment. So the next point is nature of payment. Next point is nature of payment, and this point is going to make a distinction between subclause 1 and subclause 3. Next point is nature of payment. 40A subclause 1 is applicable to which nature of payment? It is applicable when you are paying interest, when you are paying royalty, when you are making payment of fees for technical services, or you are making any other sum. Any other sum means any payment, commission, brokerage, anything, except a salary, So if you are making payment of interest, royalty, fees for technical services, or any other payment to a foreign company or a non-resident person, then 40A subclause 1 will be applicable. What if you are making a payment of salary to a non-resident person? in that case 40A sub clause 40A sub clause 3 will be applicable. In that case 40A sub clause 3 will be applicable. And 40A sub clause 1 will be applicable in respect of any payment, any sum payable to resident on which tax is deductible as per chapter 17B. Chapter 17B is the chapter of TDS. So when you make any payment to a resident person, section 40A sub clause 1A is applicable. But when it comes to payment to non-resident person or a foreign company, you make any payment except salary, 40A sub clause 1 is applicable. When you pay salary to a non-resident person, 40A sub clause 3 is applicable. I have covered 2 points. Is that very clear? Do you have any doubt in point number 1 and 2? Point number 1 and 2, do you have any doubt? No. So let us proceed to point number 3. Now, while discussing point number 3, I would restrict my discussion to 40A sub clause 1 and 40A sub clause 1A. Let me restrict my deduction to 40A sub clause 1 and sub clause 1A. As of now, because in point number 3, 40A sub clause 1, 40A sub clause 1A, both the sub clauses, point number 3 is same, 100% same. What it says, taxes should be deducted. While you make payment to someone, taxes should be deducted. Up to what time tax is required to be deducted? Tax is required to be deducted up to the end of the year. In your case, what is the previous year? 2021. So what is the end of the previous year? 31st March 21. So you are required to deduct the tax up to 31st March 21. You are required to deduct the tax up to 31st March 21. So tax is required to be deducted up to the end of the year, and this tax is required to be paid to the government up to the due date of filing income tax return. What is the due date of filing income tax return? I told you that either it can be 31st July or it can be 31st of October. So government is expecting you to do 2 things. Number 1, deduct tax. By what time tax is required to be deducted? Tax is required to be deducted up to the end of the previous year. And this tax is required to be paid to the government up to the due date of filing return. If you do both these activities, number 1, you have deducted tax up to the end of the previous year, that is 31st March 21, and you have paid this tax to the credit of government within the due date of filing return, then we say both of the conditions are fulfilled. Both the conditions are fulfilled, and deduction for the expenditure will be allowed to you. Nothing will be disallowed. Deduction for the expenditure will be allowed. Same to same explanation is applicable in case of 40A sub clause 1A also. 40A sub clause 1A also, it says the same thing. Taxes should be deducted up to the end of the year, and this tax should be paid to the government up to the due date of filing return. Means you are required to do 2 things. Between these 2 things, I have written and. What I have written? I have written and. Means deduction for the expenditure will be allowed. Deduction for the expenditure will be allowed only if you do both the things. Only if you do both the things. Means you have deducted the tax and you have also paid this tax to the government. Now friends, let's move on to 40A sub clause 3. 40A sub clause 1, sub clause 1A, point number 3 was 100% same. Now 40A sub clause 3, point number 3 is slightly different. Slightly different. What is the difference? That is what you have to identify and tell it to me. TDS should be deducted up to the end of the year, or TDS should be paid up to the due date of filing return. TDS should be deducted up to the end of the year, or TDS should be paid up to the due date of filing return. Do you believe that point number 3 is the same in 40A sub clause 3 also? Is that similar to 40A sub clause 1 and sub clause 1A? If not, what is the difference? In 40A sub clause 1 and 40A sub clause 1A, between 2 points I have written and in 40A sub clause 3, between 2 points, what I have written? I have written or. In other words, In 40A sub clause 1 and 40A sub clause 1A, you will get the deduction for the expenditure if you fulfill both the condition. If you fulfill both the condition, means you deduct the tax and you also pay the tax to the government up to the due date of filing return. But when it comes to section 40A sub clause 3, definitely you are required to do both the things. You are required to deduct tax also and pay tax also. But when it comes to section 40A sub clause 3, even if you do one thing out of two, even if you do one thing out of two, that is either you have deducted the tax or you have paid the tax. If you have done one thing out of two, then also we will not apply the disallowance to you. We will not apply the disallowance, means expenditure will be allowed as deduction. In other words, 40A sub clause 1, 40A sub clause 1A, expenditure will be allowed as deduction subject to fulfillment of two conditions: tax is required to be deducted and tax is required to be paid. Whereas in case of 40A sub clause 3, expenditure, which expenditure? 40A sub clause 3 is talking about salary. So that salary expenditure which you debit to your profit and loss account and you are making payment to non-resident will be allowed as deduction to you, even if you do one thing out of two. That is either you deduct the tax or you pay the tax. Yes, point number 3, is that very, very clear? Yes, okay, okay. So let us move on to point number 4. Point number 4. Point number 4 says when disallowance will apply. So it is just that point number 4 is written in a negative manner. Point number 3 was written in a positive manner. Na? Point number 4 is written in a negative manner. Point number 4 says that if the TDS is not deducted, sub clause 1, point number 4 says if the TDS is not deducted, then what will happen? Expense will be disallowed. Or if TDS is deducted but it is not paid up to the due date of filing return, expenditure will be disallowed. If you did not deduct the tax, or if you deduct the tax but you did not pay the tax to the government up to the due date of filing return, expenditure will be disallowed. So point number 4 is not something new. Point number 4 is same as point number 3, but here it is written in a positive language. Sub clause 1A, it says same thing. If the TDS is not deducted, then disallowance would be applicable. Or TDS is deducted but TDS is not paid within the due date of filing return, then also disallowance would be made applicable. So disallowance would be made applicable if either the TDS is not deducted or TDS is deducted but it is. Now let's move on to point 5. Point 5 says what is the quantum of deduction? Sorry, what is the quantum of disallowance? How much expenditure will be disallowed? You are debited profit and loss account by say 10,000 rupees. You made a payment of 10,000 to someone and you did not deduct TDS. You did not deduct the tax. Whether the entire expenditure will be disallowed or some portion of the expenditure will be disallowed. What is the quantum of disallowance? In section 40A sub clause 1, expenditure will be disallowed 100%. So what is the extent of disallowance? 100% of the expenditure will be disallowed in 40A clause 1. Whereas in 40A clause 1A, entire expenditure will not be disallowed, only 30% of the expenditure will be disallowed. If you have debited your profit and loss account by say 10,000 rupees and you forgot to deduct the tax, you made the payment to non-resident person, you forgot to deduct the tax, this is called by 40A surplus 1A. You have debited 10,000 to your profit and loss account, entire 10 will not be disallowed. 30% of 10,000, that is 3,000, will be disallowed. So in case of 40A surplus 1A, disallowance is not 100% of the expenditure, it is only 30% of the expenditure. So whatever expenditure is debited to profit and loss account, 30% of that expenditure will be disallowed. Is that very, very clear? So 40A surplus 1, disallowance is 100%, 40A surplus 1A, disallowance is 30%, and 40A surplus 3. 40A surplus 3, here disallowance is 100%, here disallowance is 30%, and here disallowance is 100%. By mistake I circled the next point. By mistake I circled the next point. So 40A surplus 1, disallowance is 100%. 40A surplus 1A, disallowance is 30%. 40A surplus 3, disallowance is 100%. Tell me, have you understood this point number 5? Yes, have you understood point number 5 very clearly? So disallowance in section 40A surplus 1 and 40A surplus 1A is 100% and 30% respectively. And what is the disallowance in section 40A surplus 3? 100% disallowance is 100% disallowance. Yes, is that very, very clear? Okay, now let's proceed. Now listen to me very carefully before I explain you point number 6. Now 2 points are left in these 3 sections, 2 points are left. Before I move on to point number 6, let me take you a very small, let me give you a very small example. Let me take you through very small example, and then we'll move on to point number 6. Say for example, when you were a kid, your mother had an arrangement with you saying that every day you do the homework, I will give you 2 chocolates. When you were a kid, you had a deal with your mother saying that if I do homework every day, you should give me 2 chocolates every day. Now, for example, today you did not do your homework. So question is, will you get the chocolates? Answer is definitely you are not going to get the chocolates because you have not done your homework today. Now the point is, tomorrow you have done today's homework as well as tomorrow's homework. So 2 days homework you did on the same day. Now the question is, for 1 day's homework you are getting 2 chocolates. Now the homework of 2 days got accumulated and you did homework of both the 2 days. Will you get 4 chocolates? Will you get 4 chocolates? If yes, if you get 4 chocolates, then we can say that first day you did not do the homework, we did not give you the chocolate. So this is a disallowance applied on you. This is a disallowance applied on you, and this is a temporary disallowance. Meaning thereby, if you do this today's homework tomorrow also, then today we will not give you chocolate, but this chocolate we will keep aside. And in future, tomorrow, when you complete today's homework, today's chocolate will be given to you tomorrow. In that case, we say that this disallowance which is applied to you today is a temporary disallowance. So today it is disallowed, and tomorrow if you rectify your mistake, if you complete the homework, 2 chocolates will be given to you. In that case, today when disallowance is applied to you, it is just a temporary disallowance. It is a temporary disallowance. In future, if you do the homework, today's homework also if you do in future, the today's chocolate which you have kept aside, this will be given to you. In that case, that disallowance would be considered to be a temporary disallowance. Now another possibility is, there is an agreement between you and your mother saying that if you do the homework, you will get 2 chocolates. But if you don't do homework, you are not going to get the chocolates, that is certain. But today's homework, if you do tomorrow, then also those two chocolates, you have lost forever. You have lost forever today's homework. Even if you do it tomorrow, you are not going to get the chocolates. You have to do the homework today itself to get the chocolates. So if you did not do your homework today, you are not going to get the chocolates today. And even if you do it tomorrow, you are not going to get the chocolates. In that case, we say that this chocolate is permanently disallowed to you. In future, you will never get it. For today's homework, chocolate is permanently disallowed. You will never get it back. Have you understood this example? In this second situation, I say that disallowance is permanent disallowance. Permanent disallowance means expenditure is disallowed and in future it will never be allowed. It will never be allowed. Have you understood these two situations? Now I will try to match these two situations with the situation given in the provision. We'll try to match the situation with the situation given in the provision. What it says, nature of disallowance means what if the tax is subsequently deducted and paid? What if today's homework I do it tomorrow? Will I get 2 chocolates tomorrow? If yes, then today's disallowance is a temporary disallowance. If no, then today's disallowance is a permanent disallowance. Now let us refer to 40A clause 1. It says deduction of 100% of the expenditure shall be allowed in the year in which tax is deducted. If not deducted earlier, if you are not deducted the tax, expenditure will be disallowed. But if that tax, if you deduct in future, then the expenditure deduction will be allowed to you. Say for example, I have entered into one transaction with Manoj for 50,000 rupees and I was supposed to deduct a tax of 5,000 rupees. I did not deduct that 5,000 tax, so that 50,000 amount of expenditure will be disallowed to me, will be added to my current year's income. Now next year I have entered into a transaction once again with Manoj and the transaction value is 1 lakh rupees. Transaction value is 1 lakh rupees. From that 1 lakh, I am liable to deduct a tax of 10,000 rupees. So I told to Manoj that out of this 1 lakh, I will deduct 10,000 tax. And last year, I paid you 50,000, but I forgot to deduct the tax in the last year. Of that 50,000, the tax was 5,000. So that 5,000 was a short deduction of tax. That I will deduct today from the payment of 1 lakh. So next year, I am making a payment of 1 lakh. I am supposed to deduct a tax of 10,000, but instead of 10,000, I am deducting 15,000. So past year I did not deduct the tax, expenditure was disallowed to me. In future year I deducted excess tax, past year's tax also I have deducted and that year's tax also I have deducted. So I have rectified my mistake. Will I get the deduction for the expense? Whatever expense was disallowed to me in the past, can it be allowed in the current year? Answer is yes, it can be allowed. Therefore we say that in case of 40A sub clause 1, the disallowance was temporary. In case of 40A sub clause 1, disallowance was temporary disallowance. Yes, have you understood this? Similar is the case with section 40A sub clause 1A. This disallowance is also a temporary disallowance. Means if you do not deduct the tax, expenditure will be disallowed to you. In future, if you deduct the past year's tax, in future that expenditure will be allowed to you as deduction. So this is the case with 40A sub clause 1 and 40A sub clause 1A. What about 40A sub clause 3? In 40A sub clause 3, this is permanently disallowed. The nature of disallowance is permanent, means no deduction will be allowed in future. 40A sub clause 3 talks about what? Payment of salary to a non-resident person. If I am making payment of salary to the non-resident person and if I do the mistake, I do not deduct the tax, I forgot to deduct the TDS, in that case, that amount of salary will be disallowed to me in the current year and in future also it will never be allowed to me. In future also it will never be allowed to me. In other words, whatever disallowance is there in the current year is in the nature of a permanent disallowance. It is in the nature of a permanent disallowance. Have you understood this very clearly? 40A subclause 1, subclause 1A is a temporary disallowance and 40A subclause 3 is a permanent disallowance. Yes? Yes, okay. Now friends, let's move on to the last point. These sections now, we were discussing 3 sections simultaneously. Here there are in all 7 points. Out of 7 points, I have discussed 6 points with you. Now I am proceeding to discuss 7th point with you. This is the last point. This talks about a relief. This talks about a relief. First of all, let us understand where the relief is available and where the relief is not available. In 40A subclause 1A, in 40A subclause 1, relief is available. In 40A subclause 1, relief is available. 40A subclause 1A also, relief is available. But in 40A subclause 3, relief is not available. 40A subclause 3, relief is not available. Now, what do you mean by relief is not available? Forget about that. But for the time being, you understand that in 40A subclause 1 and 40A subclause 1A, relief would be available. 40A 3, relief would not be available. What is that relief? That we'll understand as, right now only. But before that, you understand that 40A subclause 1, subclause 1A, relief is available. 40A subclause 3, relief is not available. Relief is not available. Now, here there is a printing mistake. Here there is a printing mistake. In 40A subclause 1, from this last line, you remove the word resident. You remove this word resident. This is by mistake printed here. So remove this word resident, because in 40A subclause 1, we are not making payment to resident. We are making payment to a foreign company or a non-resident person. Therefore, you remove this word resident from here. Now, shall I proceed to point 7? You understood? 40A subclause 1, 40A subclause 1A, relief is available. 40A subclause 3, relief is not available. Now, listen to me very carefully. What do you mean by relief? What do you mean by relief? For example, I am making payment to Manoj. Manoj is a resident person. I am making payment to him. Government had assigned me 2 duties. While you make payment to Manoj, you deduct the tax and pay this tax to the government. While I am making a payment to Manoj, resident person, government has assigned me 2 duties. I should deduct the tax, that is my first duty, and I should pay this tax to the government, that is my second duty. Now, say for example, I have neither deducted the tax nor I have paid the tax to the government. So while making payment to Manoj, I did not deduct the tax. And since I did not deduct the tax, I have not paid any tax to the government also. What will be the consequence? The natural consequence is the deduction for the expenditure will be disallowed. The natural consequence is deduction for the expenditure will be disallowed. Will it be permanently disallowed or it is a temporary disallowance? In 40A subclause 1, 40A subclause 1A, it is a temporary disallowance. So in the current year, when I make payment to Manoj, I did not deduct the tax, expenditure will be disallowed to me. But in future, if I am having one more transaction with Manoj, at that point of time, I deduct the tax on that transaction also and past transaction also on which I did not deduct the tax, then in future I can claim the deduction for the expense. This I have already explained to you. But here I wanted to cover a point saying that while I made payment to Manoj in the current year, I did not deduct the tax and I did not pay the tax. Natural consequence which would follow is disallowance. Natural consequence which would follow is disallowance. Government says, we will give you some relief. We will give you some relief, saying that if you do 3 activities, not me, I should get these three activities done from Manoj. If I force Manoj disallow the expenditure to you in the current year, and we will allow you the expenditure to you in the next year when Manoj is filing his income tax return. In other words, what is the relief? The expenditure which is disallowed to me in the current year will be allowed to me in the year in which Manoj is filing his income tax return without me deducting the tax. Without me deducting the tax, the expenditure will be allowed to me as deduction in the future year. Now, understand what are these three duties. Understand what are these three duties. For example, I was paying an amount of 1 lakh to Manoj. I did not deduct the tax. The tax was deductible 10,000 rupees. I did not deduct the tax. In other words, I paid entire 1 lakh to Manoj. So, number one, I have not deducted 10,000. Number two, I have not paid this 10,000 to the government. Now, what is the consequence? The 1 lakh of expenditure which is debited to my profit and loss account will be disallowed to me. Now, government says you get three jobs done from the Manoj, from the payee. First job, I'll pick up my phone, I'll call up Manoj and I'll say Manoj that, Manoj, while making you payment now, I did not deduct the tax. I forgot to deduct the tax. So do three things. Number one, whatever 1 lakh payment I've done it to you, you consider that 1 lakh in your total income. You consider that 1 lakh rupees in your total income. And that 1 lakh rupees, once it is considered in your total income, whatever is the amount of your total income, on that whatever is the amount of tax, please pay tax on your total income to the government. Please pay tax on the total income to the government. If Manoj pays tax on the total income to the government, then whatever amount I paid to Manoj without deducting tax, on that amount also he has paid tax to the government as part of his tax on the total income. So government says get three jobs done from the Manoj. Number one, call him up, ask him to ensure that the amount which I have paid to him without deducting tax, he is considering in his total income. Number two, ask him to pay tax on their total income. And number three, ask him to file his income tax return within the due date. Now, whatever due date is applicable to Manoj, either 31st July or 31st October, whatever due date is applicable to Manoj, you just ensure that Manoj is filing his income tax return within the due date. If these three jobs are done by Manoj, then government says we will allow the relief to payer. What relief will be allowed? In current year, definitely deduction for the expenditure is going to get disallowed. In the next year means the year in which Manoj is filing his income tax return, in the next year, while I compute the income of the next year, that is previous or 21-22, the expenditure which was disallowed to me in the last year will be allowed to me in the next year without deducting any tax. So previous year, I made a payment of 1 lakh to Manoj. I did not deduct any tax. In the assessment at 21-22, Manoj has considered this 1 lakh in his total income. On his total income, he has paid the tax and he has filed his income tax return within the due date. These three activities are done by Manoj, and I have taken a certificate from my chartered accountant that yes, Manoj has done these three activities. This certificate I will submit to the income tax department. So the department is confirmed that I did not deduct the tax, but government has got the tax because Manoj has paid the tax on his total income. In that case, government says we will give you relief. What is that relief? In the current year, expenditure will be definitely disallowed, but the same expenditure will be allowed to you as deduction in the year in which Manoj is filing his income tax return. I'll get the deduction for the expenditure in the year in which Manoj is filing his income tax return. Have you understood this? Yes? So relief means I am getting the deduction for the expenditure without deducting any tax in future. From my side, I have not deducted tax in the current year. In future year also, I am not deducting tax till I am getting the deduction, because Manoj has already paid the tax to the government. Yes, tell me, have you understood this? Yes or no? Yes. Okay. So let us read this now. Let us read this. If SSC has failed to deduct the tax, SSC means me, I failed to deduct the tax, and if payee has furnished his return as per the due date in section 139, payee has taken into account such sum for computing the income in such a return of income, and payee has paid the tax due on income declared by him in such a return of income. So payee has done three jobs. Number one, he has considered that income which he received without deducting tax. That income is considered by him in his total income. He has paid the tax on his total income, and he has filed the income tax return within the due date. And along with that, payer furnishes a certificate to this effect. To this effect means these three jobs are done by the payee. That certificate I would take from my chartered accountant and then submit to the income tax department. So payer furnishes a certificate to this effect from an accountant in such form as may be prescribed. If Manoj has done those three jobs and I have furnished a certificate to this effect to the income tax department, then it shall be deemed that SSE has deducted and paid the tax on such sum on the date of furnishing of return of income by the payee, meaning thereby the year in which Manoj has filed his income tax return, I have deducted and paid a tax to the government in that particular year. That is what is deemed, means in that year I will get the deduction for the expenditure. Same thing is written here in 40A sub clause 1, and same thing is written in 40A sub clause 1A. Tell me, is that very clear? We have discussed three very important sections: 40A sub clause 1, 40A sub clause 1A, and 40A sub clause 3. Yes. So 40A sub clause 2 is also over. Income tax is not considered as an expenditure, so income tax is never allowed to you as deduction. Income tax is never allowed to you as deduction. Now friends, we have some small sections to be discussed, but I don't want to discuss those sections right now. Before that, we will move on to a practical question. So I will discuss question number 12 with you. Question number 12 is a comprehensive question. It is a comprehensive question which would require the applicability of lot of provisions at the same time. Whatever provisions we have discussed till now in the chapter of PGBP, all the provisions cumulatively will be required to apply in question number 12. So this is the first question, which is the comprehensive question which we are solving. Such a kind of comprehensive questions are forming part of your examination papers. And since, see, look at the, first of all, look at the length of the question. See, manufacturing account, trading account is given to you, profit and loss account is given to you. Thereafter, you have 8 different adjustments. So around, you can easily say that question is of 1 page. 1 page question. Till you reach at the end of the question, you may forget few things which were appearing at the beginning of the question. Therefore, you have to do the marking in the question. You have to do certain markings, so that with the help of those markings, you can easily make the solution. Now, for doing this question, we need to recollect that procedure for computation of income we had discussed now. expenditure debited to profit and loss account, not debited to profit and loss account, income credited to profit and loss account, not credited to profit and loss account, which adjustments are required to be added, which adjustments are required to be deducted, all those things, plus minus, what to be added, what to be deducted, what to be ignored. All these things you should remember. Then only you can solve the question. Otherwise, it is impossible. Acha. What will be the starting point of the solution? When the SSC is following mercantile system accounting, indirect method will be followed for the purpose of computation of income, and starting point of solution will be net profit as per profit and loss account. So what is the quantum of net profit as per profit and loss account here? It is 11,300. This is the starting point of the solution. You can put a box here or you can put a circle here on 11,300. This will be the starting point of the solution. Now, before I actually move on to discuss this question number 12 with you, I would definitely like to move on to that initial part of the chapter wherein we had discussed what is required to be added, what is required to be deducted. I'll just show you that. I am not going to discuss or revise once again, but I'll show you that. See this. This we had discussed, na? Expenditure debited to P&L account, not debited to P&L account, expenditure debited to P&L account, either deduction is not allowed or deduction is allowed under other heads, they are required to be added. Expenditure not debited to profit and loss account, deduction is allowed under that PGBP, they are required to be deducted. Similarly, incomes which are credited to profit and loss account, deduction, income which are credited to profit and loss account, either they are not taxable or they are taxable under some other heads, they are required to be deducted. And finally, incomes which are not credited to profit and loss account, but they are taxable under that PGBP, they are required to be added. So all these two adjustments relating to addition and two adjustments relating to subtraction, this plus minus, what to add, what to deduct, all these things you should remember. Otherwise, you will not be in a position to start the question. So we move on to first comprehensive question, that is question number 12. Now, you know that starting point of solution will be 11,300, that is net profit as per profit and loss account. I will be doing marking here. In front of you on the screen, marking would appear. Same marking you are expected to do in your own textbook. And every time, whenever you come across any comprehensive question, you have to do the markings. So it says, question number 12 says, Mr. Inder Kumar Vasudeva furnishes the following manufacturing profit and loss account for the year ending 31st March 21. Let us do the analysis of the debit side, that is expenditure side. The first line is opening stock. Opening stock. See, anything appearing on the debit side should be considered as an expenditure, and anything appearing on the credit side should be considered as an income. Opening stock. Is it an expenditure related to business? Yes. Should deduction be allowed? Yes. Under which section deduction will be allowed? It will be allowed in section 37 subsection 1. So if the deduction is allowed, what should you do? You should ignore all those expenses which are debited to profit and loss account. Deduction is allowed while computing PGBP income. Those are required to be ignored. When I say ignore, you should actually ignore. You should not write ignore there. Against that stock, you should not write the word ignore. Ignore means you actually ignore. You don't write anything. So opening stock, purchases, manufacturing wages, these are the expenditure for which you can claim deduction in section 37 subsection 1. Factory rent, rates and taxes, you can claim deduction in section 3030, expense relating to building. So 1, 2, 3, 4, stock, purchases, manufacturing wages, factory rent, rates and taxes, all these expenses are allowed as deduction. Therefore, those expenditures should be totally ignored. Next is depreciation. You know that in income tax we give a deduction for the depreciation, which is calculated by applying the provision of section 32. And the depreciation which is debited to your profit and loss account or manufacturing account, etc., that would be definitely a depreciation calculated as per the accounting. So accounting depreciation is not allowed to as deduction. Which depreciation is allowed to as deduction is depreciation calculated by applying the provisions of section 32. So this accounting depreciation is not allowed as deduction. Therefore, it should be added back to net profit. Net profit as per profit and loss account is the starting point of the solution. Net profit as per the profit and loss account is the starting point of our solution. To this net profit, we should add the depreciation. So on the left hand side margin, I am putting the sign add. I am putting this sign add. That's all. You should not do anything. You have to just mark plus, minus, etc. And plus also one after another, it should appear in the same line. So you have to do systematic marking. You cannot do marking in a haphazard manner. You have to do marking in a systematic manner. So depreciation, this is accounting depreciation, this will be disallowed to you. Then we have gross profit, and that gross profit is 1,09,900 appearing on the debit side as well as credit side. So debit side, credit side, automatically it is net off. So there is no need to provide any effect for this gross profit also. This gross profit also, this will be ignored totally. So with this, our manufacturing account debit side we have analyzed. Let's move on to profit and loss account. Profit and loss account, we have first expenditure as office salaries. Then we have establishment expenditure. Don't consider this establishment expenditure as a preliminary expense. It is a normal expense. So this office salaries and establishment expense, both will be allowed to as deduction in section 37 subsection 1. Therefore, deduction is allowed. What you should do? You should ignore. You should ignore means you should actually ignore. Don't write the word ignore there. Otherwise, your entire profit and loss account, everywhere ignore will appear. So don't write anything. Next is interest on capital. Interest on capital. Who is paying this interest to whom? Who is paying this interest to whom? The question belongs to a sole proprietor. So interest is being paid by the business entity to the proprietor. And you know that in income tax we don't have concept of entity. In income tax we don't have concept of entity. Therefore, the business of proprietor and the proprietor, they both are one and the same entity. So how can we say that same person is paying interest and same person is receiving interest? Therefore, this will not be allowed as deduction. This interest on capital is not considered as an expenditure. It is considered as an appropriation of profit. So this appropriation of profit will not be allowed as deduction. This interest on capital is an appropriation of profit. It is not allowed as deduction. So left hand side I am putting the plus sign. Left hand side I am putting the plus sign. If at all you want to write something, you write on the right hand side here. You can write appropriation of profit. You can write appropriation of profit. Now, see, if at all you want to write, you can write, otherwise you can ignore. You can write what? Appropriation of profit. This appropriation of profit will not be allowed to as deduction. Let us proceed further. Fire insurance. If it is the insurance for building, section 30 will give you deduction. If it is the insurance for plant, machinery, furniture, section 31 will give you deduction. But this fire insurance taken for building or plant, machinery, furniture, we do not know. But in any case, we know that deduction will be allowed either in section 30 or in section 31. Somewhere deduction is allowed. So this should be totally ignored. Bad debts. Bad debts deduction is allowed in section 36 subsection 1 clause 7. We take a assumption that all those four conditions, tendencies, all those four conditions, section 36 subsection 2, debt should be incidental to business. Such a debt should have been taken into account while computing income of the assessee. Such a debt should be actually written off in the books of account. The business in respect of which debt is incurred should be continued during the previous year. Even the successor can claim deduction in respect of bad debts which is incurred by the predecessor. All these conditions are fulfilled. That is what will be our assumption. So these bad debts can be claimed as deduction. This will be totally ignored. Income tax. Income tax is an appropriation of profit. Income tax is an appropriation of profit. You cannot claim it as deduction. So income tax you can put a plus sign. This will be disallowed. Expenditure on sales tax proceedings and expenditure on income tax proceedings. Listen to me carefully. See, sales tax is gone. Now there is GST. But still the examiner can make a question wherein he will write sales tax. You should not teach the examiner that sales tax is already gone, GST is there, so this point is wrong in the question. Don't do like this. You don't teach the examiner. Whatever information he has given, based on that you make the solution, that's all. So first of all understand that income tax is not allowed as deduction, but sales tax, yes, it is allowed as deduction. Income tax not allowed as deduction, sales tax is allowed as deduction subject to section 43B. Subject to section 43B means deduction is allowed on payment basis. Deduction is allowed on payment basis. Now, this is neither income tax nor it is sales tax. What it is? Expenditure incurred in connection with sales tax proceedings and expenditure incurred in connection with income tax proceedings. What do you mean by expenditure incurred in connection with proceedings? Means there is a fight going on between you and the income tax department and you and the sales tax department in the court of law. So you need to appoint a chartered accountant or you need to appoint a lawyer. Plus you have to pay him legal fees, professional fees, and he would require a lot of evidence. Now, he would take up the photocopies from your books of accounts and documents so that he can present it to the court so that the decision can be given in your favor. So you will incur a lot of printing cost. You have to go to the court and come back. All those expenditure will be incurred now. Those expenditure is called as expenditure incurred in connection with sales tax proceedings and expenditure incurred in connection with income tax proceedings. The sales tax, income tax, we pay to the government. But expenditure in connection with sales tax proceedings and expenditure in connection with income tax proceedings, we don't pay to the government. It is expenditure incurred actually to fight a case. So it is not a tax. It is not a tax. It is a normal expenditure which should be allowed as deduction in section 37 subsection 1. Don't consider this as sales tax and income tax. If you consider this as income tax, expenditure incurred in connection with income tax proceedings, if you consider it as income tax, then you will say that income tax is disallowed. So this should also be disallowed. No, that is not the case. Income tax we pay to the government, and the expenditure incurred in connection with income tax proceedings, we don't pay to the government. It's an actual expenditure which is incurred by us. So it is a normal business expenditure. It is a litigation cost. So that should be considered as a normal business expenditure. Deduction is allowed. Deduction is allowed. Therefore, what should we do? It should be totally ignored. It should be totally ignored. Next, Diwali expenses, legal expenses, all these are expenditure incurred in connection with business. Deduction will be allowed in section 37 subsection 1. So this should be also totally ignored. Next point is medical expenses of proprietor. Medical expense of proprietor. Do you believe that this is an expenditure relating to business? No. It is a personal expenditure of proprietor. How can he debit this to his profit and loss account? This is a drawings. He should have debited this to drawings account. So by mistake he has debited here, considering it to be a business expenditure, but he is wrong. So this is not a business expenditure, this is a personal expenditure. This should be totally disallowed. Therefore we are adding back. We are adding back And if you want to write a reason, you can write it is a personal expense. It is a personal expense. Since it is a personal expense, deduction is disallowed. Income tax, what reason you can write? Income tax, it is specifically disallowed. Income tax is specifically disallowed. Income tax, we have a separate section 48 clause 2 to disallow the income tax. So income tax is an appropriation of profit and is specifically disallowed. Next point is staff welfare expenses, repairs to staff quarters, all this is related to business, this is allowed as deduction. Security deposit for telex connection, see this security deposit, ideally it should appear on the balance sheet asset side. Your accountant by mistake he has debited profit and loss account. But if you refer to section 37 subsection 1, it says that security deposit given in connection with telephone and telex connection will be allowed as deduction. Will be allowed as deduction. This is already debited to a profit and loss account. So what should we do? We should ignore. We should ignore. So all the staff welfare expenses, repairs of staff quarters, security deposit for telex connection, these all things will be ignored. These all things will be ignored. Friends, next point is bonus payable to employees. Bonus payable to employees. Can you recollect any section? Bonus to employees? Yes. Can you recollect any section? Yes, 43B, very good. 43B. Can you recollect one more section where the deduction is allowed for the bonus to employees? Bonus to employee deduction is not allowed in 43B. 43B is not a section which is allowing you deduction. 43B is putting a restriction saying that deduction will be allowed only if the actual payment is made. The section which will actually allow you deduction for the bonus is not section 43B, it is section 36 subsection 1 clause 2. On page number 129 in your textbook, we have point number 4. Here we have section 36 subsection 1 clause 2. Bonus or commission paid to employee for services rendered where such bonus is not payable to them as profits or dividend. This is subject to 43B. Deduction is allowed subject to 43B. What do you mean by subject to 43B? Subject to 43B means deduction will be allowed on payment basis. So, section 36 subsection 1 clause 2 is a section which is allowing you deduction, whereas section 43B is putting a restriction saying that deduction will be allowed only if the payment is made. So, if you refer carefully that profit and loss account, they are using the word bonus payable to employees. Bonus payable to employees, meaning thereby it is not actually paid. It is not actually paid. Therefore, what should be done? It should be disallowed. It should be disallowed. We should add back, and here we should give a reference to which section? Section 43B. Section 43B. Yes, have you understood this? Shall we proceed? Very good. Next point is provision for tax. Sales tax and excise duty. Yes, tell me, sales tax, excise duty, is it allowed as deduction? Yes, it is allowed. It is allowed, but that payment is that is allowed as deduction subject to section 43B, means deduction is allowed on payment basis. Deduction is allowed on payment basis, and here they are using the word provision. Provision means what? Payment is not made. Payment is not made. That tax is just accrued, it is not paid. So this is not an actual payment, so it will be disallowed. Actual payment is not done, so it will be disallowed because of section 43B. Because of section 43B. Hope friends, these 2 points are very much clear too. Next is municipal tax for the staff quarters. Municipal tax for the staff quarters will be allowed as reduction in section 30, expense relating to building. So we should ignore that. We should ignore that. Next is general reserve. General reserve is not an expenditure. It is an appropriation of profit. Appropriation of profit should not be allowed as reduction. Therefore, we should add back. Therefore, we should add back. Now here if you want to write, you can write appropriation of profit. Generalism is appropriation of profit. This appropriation of profit will not be allowed to you as deduction. Next is entertainment expenditure. Breach of contract. So penalty broadly we can divide into number 1 penalty for breach of law and number 2 penalty for breach of contract. Now first of all let us try to understand what is the difference between these two penalty. First one is penalty for breach of law and second one is penalty for breach of contract. I had given you one example while explaining you section 28. I would like to remind you of the same example. I gave you an example saying that, for example, there is a contract between Tata Motors and MRF Tires, Madras Rubber Factory, MRF Tires. There is a contract between Tata Motors and MRF Tires saying that every day MRF Tires would supply 100 tires to Tata Motors. So Tata Motors is dependent on MRF Tires for assembling 25 cars a day. So there is a contract between Tata Motors and MRF Tires saying that MRF Tires should deliver 100 tires every day to Tata Motors. If MRF Tires fail to fulfill its obligation, in other words, they don't deliver 100 tires on a particular day, in that case, they will have to pay a penalty of 25,000 rupees. Every default, they will have to pay a penalty of 25,000. Now, say for example, throughout the previous year 2021, out of 365 days, MRF Tires failed on 10 occasions. They did default 10 times in a year. So, every time they have to pay a penalty. How much penalty? 25,000 rupees. So, throughout the year, MRF Tires would have paid a penalty of 2,50,000 to the Tata Motors. For Tata Motors, it is an income. For Tata Motors, that penalty is an income. It will be credited to profit and loss account and it will be taxable in section 28. But that same penalty is an expenditure for MRF Tires. MRF Tires would debit its profit and loss account and it would ask for deduction. Question is whether deduction will be allowed. Answer is yes, deduction will be allowed. Because there might have been some reason behind making the default. No one will do the default willingly. So definitely MRF Tires knows that if we do the default, we'll have to pay 25,000 rupees as penalty to Tata Motors. Why they will do the default willingly? There might be some reason because of which they have done a default. So this is called as a penalty for breach of contract. This is called as a penalty for breach of contract and deduction is allowed. Deduction is allowed. Yes, is that very, very clear? So penalty for breach of contract, deduction is allowed. Next is penalty for breach of law. Next is penalty for breach of law. This can be further divided into two. Penalty which is penal in nature. Penalty which is penal in nature. And number two, penalty which is compensatory in nature. Penalty which is penal in nature and penalty which is compensatory in nature. What do you mean by penalty which is penal in nature? Penalty which is penal in nature means you have done some default, you have breached the law and government wants to teach you a lesson. That is the reason government has levied the penalty. That penalty is penal in nature. That penalty is not allowed as deduction. That penalty is not allowed as deduction. But we have one more penalty which is compensatory in nature. We have one more penalty which is compensatory in nature. See, you have something called as penal interest. Penal interest. Penal interest is in the form of penalty only. For example, due date for payment of tax was 31st July. For example, due date for payment of tax was 31st July, but you actually paid the tax only on 31st August. So can I say you have paid the tax, but you have paid the tax after the due date? You have made the payment delay, na? Delayed the payment by 1 month. So government will charge you penal interest. Why government is charging you penal interest, na? Because if you would have paid the tax on time, na, that money would be lying in the government's bank account. Government would have earned interest on that amount. And since you have not paid the tax on time, that money might be lying in your own bank account. So you might have earned interest on it. So government says, since you did not pay tax on time, we did not receive money on time. If we would have received money on time, we would have earned some interest on that. So since you did not pay money on time, we are going to levy a penalty interest on you, so that whatever loss we suffered for not getting the interest, that loss will be compensated. That loss will be compensated. So we did not pay taxes to the government on time. So government has lost an opportunity to earn the interest on that amount. That loss to the government is recovering by charging interest to you. That interest is called as a penalty interest, and that penalty is compensatory in nature. Deduction is allowed for that penalty. Deduction is allowed for that penalty. Now the question is, now the point is, examiner would give you penalty on the debit side of profit and loss account. He will not tell you whether it is penalty for breach of contract, or whether it is penalty for breach of law, whether it is a penalty which is a penal in nature, or whether penalty is compensatory in nature. He will not mention anything. If it does not mention anything, then what will happen? Then in such case, we will presume that penalty is penal in nature. We will presume that penalty is penal in nature. In other words, deduction will not be allowed. Deduction will not be allowed. So we were discussing question number 12. I told you that our starting point of solution would be net profit as per profit and loss account, which is 11,300. Debit side we have analyzed. So now we need to analyze the credit side. We need to analyze the credit side. Okay. So before the break, I discussed penalty with you in summarized manner. So penalty for breach of contract deduction is allowed. Penalty for breach of law, if it is penal in nature, deduction is not allowed. If it is compensatory in nature, deduction is allowed. That is what we discussed. What if the question is silent? If question is silent, then we will take an assumption that penalty is penal in nature and deduction will not be allowed. Now, profit and loss account credit side, we were on a point refund of income tax penalty. My question to you is, when you pay penalty, deduction will be allowed or deduction will not be allowed? When you pay penalty, penalty would appear on the debit side of your profit and loss account. When you pay penalty, that penalty would appear on the debit side of your profit and loss account. Question is, whatever penalty you have debited to your profit and loss account, will it be allowed as deduction or it will not be allowed as deduction? Yes? It will not be allowed as deduction. So since while you pay penalty, deduction is not allowed. When you pay penalty, deduction is not allowed. So when you get refund of penalty, should it be taxed or it should not be taxed? When you pay penalty, you debit your profit and loss account, we are not giving you any deduction. So when you get the refund of penalty, should we levy tax or we should not levy tax? We should not levy tax. Simple rule is, it is very simple rule, tit for tat. When I debit my profit and loss account, you don't give me deduction. When I credit my profit and loss account, I am not going to pay any tax on it. So when I debit the penalty to my profit and loss account, You are saying that this penalty is penal in nature, so you are not allowing me deduction. So same penalty when I get refund. Why I would get the refund of penalty? Because I might have paid some extra penalty. I might have paid extra amount of penalty, so that extra amount is getting, I am getting the refund of extra penalty paid. So when I paid the penalty, I did not get the deduction. So when I get the refund of penalty, that refund of penalty is not taxable. So this refund of penalty is not taxable. So what should we do? We should put the minus sign. We should deduct here. We should put the minus sign. This amount should be deducted. Sale proceeds of machinery. Yes, tell me, what do you mean by sale proceeds of machinery? Money realized on sale of machinery. This your accountant has done the mistake. Sale proceeds of machinery should never be credited to profit and loss account. What should be credited to profit and loss account is profit on sale of machinery. Instead of crediting profit on sale of machinery to the profit and loss account, your accountant has credited sale proceeds of machinery. It is a mistake. It is an accounting mistake. It is an accounting mistake. But can you tell me what should be the treatment of the sale proceeds of machinery? The selling price of an asset should be deducted from the value of the block. So while we calculate the depreciation, this amount will be deducted from the value of the block. Right now this amount is appearing on the credit side of profit and loss account. I will not pay any tax on this because this amount will be deducted from the value of my block. And then if my WDV is positive and there are assets in the block, I would claim the depreciation. Otherwise, I will have a short-term gain, short-term loss. So this sale proceeds of machinery should not be taxed. It should not be taxed. So I am putting the minus sign here. A recovery of bad debts not allowed to be deducted in earlier years. See, while explaining of bad debts itself, yesterday only I told you that bad debts is allowed as deduction subject to fulfillment of 4 conditions. Now, it is not necessary for me to prove that bad debts is incurred. Without proving itself, I will get deduction. So, generally, once I write off the bad debts, it will be allowed to me as deduction. Few years back, if you wanted a deduction for bad debts, you were required to prove that bad debts is incurred. But as of now, there is no such thing. Means as of now, without proving that bad debts is incurred, you can claim the deduction just by writing off your debtors. So as of now, whenever you debit your profit and loss account by bad debts, definitely it will be allowed as deduction. But here see, the examiner has given you a question wherein he says that recovery of bad debts not allowed to be deducted in the earlier year. Meaning thereby, when you debited your profit and loss account with bad debts, that was not allowed to you as deduction. So when you recovered that bad debts, it has become a bad debts recovery. At that point of time, that should not become taxable. That should not become taxable. Therefore, we are deducting this. It is not taxable. We are putting the minus sign. So you should not do any marking. Only plus minus signs you have to put, that's all. No marking, you will be just putting the plus and minus sign. Next point is sundry receipts. Next point is sundry receipts. See now, what is this sundry receipts? I do not know. There might be some small incomes. Specifically, I do not have the details of sundry receipts. So in the absence of specific information, we presume this sundry receipts should be related to your business and it is taxable. These sundry receipts are related to your business and they are taxable. Therefore, this 35,000 will totally ignore. We will ignore this 35,000. So we have analyzed the debit side. We have also analyzed the credit side. Now we move on to the adjustments. Here it says you are required to compute the taxable profits from business. You are required to compute taxable profit from business after taking into account following consideration. Number 1, purchase include a petty purchase of 21,000. Purchase include, see, whatever purchase is debited to your profit and loss account, that purchase includes a petty purchase of 21,000 whose payment was made by a bearer check. Which section comes to your mind looking at this adjustment? Section 40 capital A subsection 3 should come to your mind. The transaction value is more than 10,000. Payment is also made and it is more than 10,000 rupees and payment is made by a bearer check. So what should we do now? We should go to the trading account debit side. Trading account debit side here, we should put the plus sign. First of all, we should put the plus sign, and debit amount is 80,000. Out of 80,000, we are going to disallow 21,000. So put the amount of 21,000 here, and on the right hand side you can write 1 in the bracket, meaning thereby it is connected to adjustment number 1. It is connected to adjustment number 1. This is the way in which you should do the marking. Adjustment 1 is gone. Adjustment 2, SSE has always valued the stock at cost price, but since the previous year 2021, that is the current year, he has valued the stock at market price, which was in excess of the cost price by 10%. In your 12th standard or somewhere in 11th standard, there was a chapter called as final accounts in accountancy. There was an adjustment, overvaluation of stock and undervaluation of stock. What is this? This is what? This is overvaluation of stock. You have valued the stock at a market price and your market price is higher by 10% as compared to the cost price. So can you tell me to what extent it is overvalued? Yes. Credit side of your trading account, the stock is appearing at 26,400. Can you tell me out of this 26,400, to what extent this is overvalued? Can you tell me the amount? 2,400. So this 26,400 is overvalued by 10%. So if the correct valuation is 100, you have valued 10% more than that. In other words, you have valued at 110. So this 26,400 is nothing but 110. So what is the proportionate value against 10? So you do the cross multiplication and you find out the overvaluation will turn out to 2,400. Now the point is, closing stock you have recorded more by 2,400. Closing stock is an item of expense or it is an item of income? Definitely it is an item of income. Closing stock is an item of income. So if you have overvalued the closing stock, you have written higher amount on the credit side. If you write the higher amount on the credit side, what impact it will have on the net profit? Net profit will increase. If you write the higher amount on the credit side, net profit will increase. But this net profit has wrongly increased. This net profit has wrongly increased. What should we do now? Yes, should we add a 2,400? Should we deduct a 2,400 or we should ignore? We should subtract. Because this is wrongly appearing on the higher side. So here I'll write an amount of 2,400 and I'll put the minus sign. I have written the amount of 2,400. I am putting the minus sign. I am putting the adjustment number as 2. Adjustment number 2, 2,400. I am putting the minus sign. With this, point number 2 is over. Point number 3 says, office salary paid include 10,400 paid to the proprietor of the business. What is this? When you pay to the proprietor, what it is? Yes? When you pay to the proprietor, what it is? It is nothing but appropriation of profit. It is drawings, it is appropriation of profit. This will not be allowed as deduction. So office salaries 10,400. You move on to office salaries, first line of your profit and loss account. First of all, put the plus sign here. Then you write the amount of 10,400 here. Put the plus sign, write the amount of 10,400 and then you write the adjustment number. What is that adjustment number? That is adjustment number 3. Adjustment number 3. Hope you are understanding how you have to do the markings. Next, point number 4 says, Diwali expenses include gift of 1,000 rupees made to the relative. See, if you gift something to your relative, is it a business expenditure or it is a personal expenditure? Definitely it is a personal expenditure. Why should we give you deduction for the personal expenditure? So that amount should be disallowed to you. 1,000 rupees, which is part of this Diwali expenses of 4,000, that 1,000 rupees should be disallowed. So against Diwali expenses, I am putting the plus sign. I am writing the amount of 1,000 rupees. And here I will put the adjustment number as 4. Adjustment number is 4. Now I move on to point number 5 and 6 at the same time. Now I move on to point number 5 and 6 at the same time. You will have to help me out. Point number 5 and 6, you will have to help me out. See what it says. The WDV of block consisting of machinery as on 1st April 2020 is 59,000. So what is this 59,000? This is nothing but the opening WDV. Opening WDV of block of machinery is 59,000. Further it says machinery whose WDV as on 1st April 20 was 5,000 was sold during the year. When you sell the asset, we deduct the selling price from the value of block. What is the selling price of this machinery? Do you believe it is 5,000? Yes? No, it is not 5,000. Refer to your profit and loss account. There you had seen na sale proceeds of machinery. What is the selling price? 25,000. So here you can connect this to adjustment number 5. You can connect the sale proceeds of machinery entry to adjustment number 5. 25,000 is the selling price. See what is the opening WDV of this asset which is sold 5,000. This is not relevant for us. What is relevant is selling price. So what shall we do? We shall deduct the selling price of 25,000 from the value of block. So now can you refer to this and give me what is the amount of depreciation for machinery? What is the format for computation of depreciation? You would take up the opening WDV. To that you will add the actual cost of asset which is acquired during the year and put to use. You will take the total. From that total you will deduct the selling price to arrive at the amount of closing WDV. If that WDV is positive and there are assets in the block, you would calculate depreciation. At what rate? 15%. If the rate of depreciation is not given here, to plant and machinery we should apply general rate of depreciation which is 15%. My question to you is, how much is the amount of depreciation on this machinery in point number 5? I have got the answer from Arun. He says depreciation is 5,100. He says depreciation is 5,100. Is he correct? I have got one more answer from Vishnu. I have got multiple answers now. Yes, everyone says yes, 5,100 is correct. So my depreciation is 5,100. Here only I am writing opening WDV is 59,000. To that I should add the actual cost of asset acquired and put to use during the previous year is 0. From that I should deduct the selling price of assets sold, 29,000. If I calculate this, I would arrive at an amount of 34,000. This I multiply by the rate of depreciation 15%. I would get an amount of 5,100 as my depreciation machinery. Yes, have you all understood? This is a simple calculation we have done. In the examination, in the solution, you have to make a working note, you have to put up the format for calculation of depreciation, and then you have to calculate. That is just a presentation. But the amount which is depreciation on machinery is 5,100. Yes, similarly, point number 6. First of all, have you all understood this amount of 5,100? Yes? $5,100 is very clear? Okay, let's move on to the next point. Next point is point number 6. WDV block consisting of factory building as on 1st April 20 was 90,000. See, WDV block of building value is 90,000. During the year, I have not acquired any building, I have not sold any building. So my opening WDV and the closing WDV would remain the same. My opening WDV and the closing WDV is going to remain the same. And what is the depreciation rate in case of building? You know it is 10%. So you calculate 10% depreciation. 90,000 is my opening WDV. New building acquired is 0. What is sold is also 0. So my closing WDV is 90,000. On that I'll take depreciation at 10%, and that would be 9,000 rupees. That would be 9,000 rupees. So I have two adjustments, adjustment number 5 and adjustment number 6 with respect to depreciation. What is my total depreciation? 9,000 plus 5,100, that is 14,100. 14,100. So I move on to my trading account. Here I have added depreciation 15,000. So I should write here adjustment number 5 and adjustment number 6. Because of this, I am going to deduct an amount of 14,100. Because of adjustment number 5 and adjustment number 6, I am going to deduct an amount of 14,100. So 15,000 is an accounting depreciation that will be added. We'll make a working note. We'll calculate the amount of 14,100, and that 14,100 will be deducted. So accounting depreciation will be added, income tax depreciation will be deducted. So I had two adjustments, adjustment number 5 and 6 with respect to depreciation. Now I move on to 7th adjustment. Sales tax and excise duties amounting to only 20,000 were paid on or before 31st July 21. What is 31st July 21? 31st July 21 is nothing but the due date of filing income tax return. Up to that date, you have paid 20,000 sales tax and excise duty. See, in your profit and loss account, there is a provision for payment of sales tax and excise duty. There we had decided to disallow the entire amount of 25,000. But now referring to this adjustment number 7, we came to know that out of 25,000, 20,000 is already paid within the due date of filing income tax return. So 20,000 will be allowed as deduction. So what will be disallowed is only 5,000. What will be disallowed is only 5,000. So 5,000 will be added back. 5,000 will be added back. Have you understood this adjustment number 7? Yes? Now let's move on to the last adjustment. Adjustment number 8, Adjustment number 8. Actually, it is not related to income tax, it is related to accounts. It is not related to income tax, it is related to accounts. See what it says. Sales include goods withdrawn. Goods withdrawn is nothing but drawings. If goods are withdrawn, what entry you should pass in your books of accounts? Drawings account debit to goods withdrawn by proprietor, and this goods withdrawn by proprietor should appear on the credit side of trading account. Instead of that, the SSE has passed an entry, drawings account debit to sales account. SSE has passed an entry, drawings account debit to sales account. That is the reason the drawings are included in sales. See, accounting wise it might be incorrect. Accounting wise it might be incorrect, but it will not have any impact on the profit, because anyway it is appearing on the trading on credit side only. Whether it is included in sales or whether a separate entry is passed, anyway it is appearing on the credit side of trading count. So it should ideally not have impact unless and until entry is passed for a wrong amount. So ultimately it is having an impact on the credit side. Further it says, sales include goods withdrawn by Mr. Ender during the year for 10,000. Goods are withdrawn for 10,000. The cost of these goods was 12,000 and the market value is 9,000. Now you are having three amounts. Number one, entry is passed in the books of account for goods withdrawn at 10,000 rupees. Cost of these goods is 12,000 rupees and the market price of these goods is 9,000 rupees. Now first of all you tell me, no income tax, there is no provision with respect to income tax. You tell me, in books of account you should pass the drawings entry at what price? Drawings entry should be passed in the books of account at what price? Yes? It should be passed at cost. It should be passed at cost. So here entry is also incorrect and amount is also incorrect. Instead of passing an entry drawings account debit to goods withdrawn, he has passed an entry drawings account debit to sales. Well, that is okay. If that entry is wrong, that is okay, because ultimately it is having an impact on the credit side. But the amount is also wrong. Amount is also wrong and that is not acceptable. Instead of passing an entry at 12,000, he has passed an entry at 10,000. So on the credit side, 2,000 is appearing less. On the credit side, 2,000 is appearing less. In sales only, you include the drawings in sales, we don't mind because it will appear on the credit side only, but the amount is wrong. Instead of 12,000, entry is passed at 10,000. On the credit side, if you pass an entry lower by 2,000 rupees, what will be the impact on your profit? What will be the impact on your profit? Your profit which is shown in the profit and loss account will be lower by 2,000. Will be lower by 2,000 rupees. So what should we do about this 2,000? Should we add or should we deduct or should we ignore? We should add 2,000. We should add 2,000. So I am putting the plus sign. I am writing an amount of 2,000 rupees and I am writing the adjustment number. Adjustment number is 8. Adjustment number 8. Friends, with this our discussion with respect to question number 12 comes to an end. Now we have to make a solution. What will be the format of the solution? We'll write statement of computation of income from business profession. Statement of computation of income from business profession. Thereafter I'll make 3 columns. 1 column for particulars and 2 columns for amounts. That is, the format is similar to bank reconciliation statement format. Then in the first line, I will write net profit as per profit and plus sign here. All these things will be added. All these things will be added. In the first heading itself, everything will be added. Thereafter, I will move on to the credit side. And wherever I have put a minus sign, 4 amounts, minus sign I have put it. For that, I will write amounts credited to profit and loss account or income credited to profit and loss account, not taxable or taxable under other heads. Not taxable or taxable under other heads. Those are required to be deducted. Those are required to be deducted. Then we have one more plus sign here. What is this? Drawings entry under recorded. Drawings entry under recorded, that is required to be added, 2,000 rupees. That should be separately, we should give a separate heading for it and we should add that. Thereafter, in adjustment number 5 and 6, you have a depreciation, na? 14,100. That 14,100 should be deducted. 14,100 should be deducted. So I should write in heading, expenses deductible as per the provisions of income tax rules, and I should deduct 14,100 as my depreciation. I will share the solution with you. I am having the printed solution. I am having the solution. I will present the solution in front of you. But before that, I can give you maximum 3 minutes time. I can give you maximum 3 minutes time. Pick up the calculators, do the adjustment, and give me the amount of income from business profession. Your solution will start from which amount? 11,300 net profit as per profit and loss account. Pick up the calculators. Start your solution with net profit as per profit and loss account. Do all the adjustment and you give me the amount of income from business profession. You give me the amount of income from business profession. I have got one answer from Akshaya saying that income from business profession is 78,400. Yes. I have got two more answers. 3 answers. All of them are same. That is 74,500. 74,500. Now most of you may get the correct answer. 74,500 is appearing to be the correct answer. Akshaya, your answer doesn't appear to be correct. Okay, pick up the calculator. Our solution would start with net profit as per profit and loss account, which is how much? 11,300. Let us calculate. 11,300. 11,300. To that I would add what? 21,000 goods purchased in cash. 21,000 I will add. To that I will add 11,300 plus 21,000. That gives me 32,300. To that I would add depreciation 15,000. Then I would add office salary includes salary to proprietor 10,400. Then I would add interest on capital 3,300. I would add income tax 6,000. Diwali expenses included a personal expense to the extent of 1,000, that would be added. Medical expense of proprietor 3,000 would be added. Bonus payable to employees, entire amount of 20,000 will be added. Provision for sales tax and excise duty, we will add up only 5,000 because 25,000 is already paid up to the due date of filing return. General reserve will be added 26,000. General reserve will be added 26,000. Thereafter, I would deduct overvaluation of closing stock 2,400, that will be deducted. Refund of income tax penalty 2,000 will be deducted. Sale proceeds of machinery 25,000 will be deducted. Recovery of bad debts not allowed to be deducted in the earlier years 6,000, this will also be deducted. Besides that, depreciation of 14,100 will be deducted. Depreciation of 14,100 will be deducted. And lastly, drawings entry recorded at a lower amount, this will be added by 2,000. Yes? Give me what is the answer? Every one of you are getting 74,500. Yes or no? Yes, see how your solution would appear, how your solution would look like. Net profit as per profit and loss account 11,300. Net profit as per profit and loss account 11,300. I'll give the first heading, expenses debited to profit and loss account but disallowed or considered separately. Purchase exceeding 10,000 paid by bearer check 48.3, 21,000. This is included in purchases. Depreciation as per the accounts 15,000 will be added back. Salary paid to proprietor 10,400 is added. Interest on capital 3,300. Income tax 6,000. Gift made to relative is a personal expense 1,000 rupees is added. Medical expense of proprietor is a personal expenditure. This is added. Bonus outstanding not paid within the due date of filing return 20,000 is added. Sales tax and excise duty 5,000 is added. Transfer to general reserve 26,000 is added. Drawings under recorded. Drawings under recorded by 2,000, that is also added. So addition related adjustments are 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 11 amounts. I should take the total and I should take the total to the outer column. It will give me 1,12,700. 1,12,700 I will transfer to the outer column. Then I will put the heading amount credited to profit and loss account not taxable or taxable under other heads. First in that would be overvaluation of closing stock 2,400, refund of income tax penalty 2,000, sale proceeds of machinery 25,000 and bad debts recovered 6,000. Take the total 25 plus 6 is 31 plus 4,400 is 35,400, that will be deducted. Then lastly you have depreciation as per the income tax provisions. This is not debited to P&L. What is debited to P&L is accounting depreciation. This is income tax depreciation. This will be deducted. 14,100. So you arrive at the amount of 74,500. You arrive at the amount of 74,500. Then we have a working note for calculation of depreciation. Machinery block opening W is 59, purchase is 0, sale is 25, closing W is 34,000. I take up 15% of that, 5,100. Building 10% of 90,000, 9,000. Total depreciation 14,100. Yes, is that very clear? Shall I proceed? Have you understood the presentation very clearly? So presentation in income tax subject, presentation is not a challenge. Most of the chapters you have only same format, particulars, amount. Presentation is not a challenge. It is just that you should understand the provision, remember the provision, apply the provision, find out what is required to be added, what is required to be deducted, what is required to be ignored. That's all. So friends, with this question number 12, discussion is over. If any one of you are having any doubt in question number 12, please do ask. This was a very big question, not that big, average question, but it was the first question. I did a lot of markings here. Now we have question number 13 and 14 also. Question number 13 is a bigger question. Should I discuss some theory as of now? Should I discuss some theory? Let us refer. Adjustment number 7 you want me to explain? Adjustment number 7. Okay, one second. Ronak says no theory. Adjustment number 7 I will explain you. What it says? Sales tax and excise duty amounting to 20,000 were paid on or before the due date of filing return. See, section 43B, you know that section 43B says either you make the payment up to the end of the year, or you make the payment up to the due date of filing return. In that case, we will give you deduction. How much amount is debited to your profit and loss account? How much amount is debited to your profit and loss account as sales tax and excise duty? 25,000 is debited. Out of 25,000, how much you have paid within the due date of filing return? 20 is paid. So what should happen about that 20? 20 should be allowed as deduction. 20 should be allowed as deduction. So what should be disallowed? Out of 25,000, 20,000 is paid within the due date. So 20,000 should be allowed. What should be disallowed is only 5,000. What should be disallowed is only 5,000. Yes, have you understood? Mr. Redmi, have you understood? Say yes or no. Okay. Aditi madam, bad debts is a loss for you. So bad debts should be allowed as deduction to you. If the bad debts is allowed as deduction to you, and in future bad debts is recovered, that bad debt should become taxable to you. But if the bad debts was not allowed to you as deduction in the past, then bad debts recovered should not be made taxable. This is what we discussed yesterday. I am taking you to that presentation. See this. Bad debts versus bad debts reduction. Sorry, bad debts versus bad debts recovered. Not this one. Yes, this one. This one. If bad debts was allowed as deduction in the past year, your business income will be lower, your total income will be lower, tax liability will be less. Bad debts, if it is allowed as deduction, your income will fall now, so you will pay less tax. In future, if that bad debts is recovered, you have to pay tax. So that bad debts recovered is taxable. So here we say this bad debts recovered is going to become taxable to you. But if the bad debts was not allowed as deduction to you in the past years, and in the current year bad debts is recovered, it will not be taxed. Why it will not be taxed? Because bad debts was not allowed to as deduction in the past means what? You might have debited your profit and loss account by the amount of bad debts. We did not allow you deduction. Means that amount of bad debts was added to your income in the past year itself. It is already taxed. So once you recover that bad debts, it is not going to be taxed. Yes, Aditi madam, have you understood this? Yes, what is adjustment number 2? Adjustment number 2 is overvaluation of closing stock. Overvaluation of closing stock. Tell me, have you understood the amount of 2,400, how it is arrived? Your closing stock is overvalued by 10%. Meaning thereby, if the value of closing stock was 100 rupees, then instead of recording closing stock at 100 rupees, you have recorded 10% more. That is, you have recorded 110. You have recorded 110. So you do the cross multiplication, simple. Twelfth standard, this adjustment was appearing as part of final accounts. For example, the correct valuation of closing stock is 100, but you overvalued it by 10%, that is 10. In other words, you valued at 110. What is the value of closing stock given to you in the question? 26,400. So what is the extent of overvaluation? That you can find out just by doing the cross multiplication. So 26,400 divided by 110 multiplied by 10. This will give you 2,400. So your closing stock should have been debited to your, closing stock which would have been credited to your profit and loss account should have been 24,000. But instead of 24,000, you have credited 26,400. If you credit more amount to your profit and loss account, what is the consequence? Your income will increase. your income will increase. It has already increased. So what should we do now? This increase in the profit is wrong. It is by mistake. So we should deduct. We should deduct 2,400. Yes, Aditi madam, have you understood? Okay. So now first of all, let us do the stock taking. Let it take 2-3 minutes time. We'll do the stock taking as to what we have completed in this chapter. What we have completed now, we'll do the stock taking. See, PGBP chapter started at page 98. Page 98 is over. Page number 99 is over. 8 point. Wait for some time now. See, any one of you having any doubt, while I explain only, you should drop the message. While I explain you any adjustment, if you have not understood, don't allow me to proceed. Don't allow me to proceed further. At that point of time only you say that, sir, please explain once more. So that once we proceed further, once we complete the solution, then if you ask me, I will explain, but it will consume more time. If I am discussing a particular point, at that point of time, if you drop the message, I will read and accordingly I will cover up. Later on also I will explain. I don't have the objection in explaining you, but it will consume more time. Page number 101 is over, 102 is over, 103 is over, 104 is done, 105 is done, 106 is done, 107 is also over. Page number 108 is over, 109, 110, 111, 112. 112, explanation 1, this first part is over. It was already discussed with section 35. Do you recollect? Asset acquired for scientific research. Scientific research is over. Now we are transferring that asset to normal use. What should be added to your block? What should be added to your block? Unexhausted amount, unabsorbed amount should be added to your block. This we have discussed with section 35. This now we are going to discuss with the chapter of capital gain. So this is pending. Besides that, page 112 is over. Page 113. Page 113 says what? Explanation 1. This I told you that I will be discussing with section 35 AD. This actually it is over. This is actually over. What is that? Any capital asset which was purchased by the SSE on which deduction has been allowed or is allowable to the SSE under section 35 AD. If you acquire any asset, to be used for specified business, then you claim the deduction for the entire cost of asset. What should be added to the value of block is 0. Nothing should be added to the value of block. On that you are not going to get any depreciation. So this is also discussed. Page number 113 is over. 114 is over. 115 is over. 116, 117, 118, 19, 20, 21, 22, 23, 24, 25, 26, all these sections are over. 27, all these pages are gone. 128, 129, 130, 130, 132, 133 is over, 134 is over, 135. 135, we are yet to discuss three sections. 40A clause 2B, 40A subclause 5 and 40A subclause 4. 40A subclause 4 right now I will not be in a position to discuss. I need to discuss the provident fund concept in the chapter of income from salaries. Only after that I can discuss this. So this is kept as pending. Now we have 40A clause 2B and 40A clause 5. We have 40A clause 2B and we have 40A clause 5. We also have section 37 2B. These three sections, these three small sections are required to be discussed. So we will discuss this so that will also be over. See, everything is over up to page number 140. Up to page number 142, everything is over. Section 40A 9 is pending. And 2-3 small sections are pending. (40A clause 2B). From examination point of view, this is very less important. From examination point of view, it is not important. Still, I will explain you. 2-3 small sections will do, and then we will move on to practical questions. We have 2 more questions to be discussed, very big question, question 13 and 14. 14 is average size question, 13 is slightly bigger question that we will discuss today. But before that, let me cover up one small topic. Say for example, there is a state government. There is a state government here. And there is a state government undertaking. There is a state government undertaking. State government undertaking means you can consider it as a state government company. You can consider it as a state government company. First of all, let me give you an example. What is that provision? See, all the natural resources which are there in the state, or those natural resources, state government is having the right. Central government doesn't have any right on those natural resources, only the state government is having a right. For example, Jharkhand, there is a state called as Jharkhand. In Jharkhand, we have a lot of coal mines. So earlier what used to happen is, state government used to give contract to the private players, saying that from this mine you extract the coal. From this mine you extract the coal and you sell the coal in the open market. And based on the quantity of coal extracted, you pay us the royalty. So contracts were given to the private players. Those private players were asked to extract the coals from the mine and sell it in the open market and pay certain fixed amount of royalty to the state government. But these private players were taking the undue advantage of this situation. What they used to do is, they used to extract, say, 1,000 ton of coal. Contract was given to a private player. He extracted 1,000 ton of coal. But in the records, he recorded only 800 tons of coal. Means he has extracted only 800 tons of coal. So he would pay royalty to the state government only on 800 tons. 200 tons. He has actually extracted 1,000 ton of coal. But in the records he is mentioning only 800 tons. So on balance 200 ton of coals, balance 200 ton of coal, that 200 ton of coal he will sell it in the open market, he will realize money in cash, and on that 200 ton of coal he will not pass any entry in the books of account, he will not even pay royalty to the state government. He will not even pay royalty to the state government. So these private players were into malpractices. They were not paying the correct amount of royalty to the state government. State government came to know about this. So one fine day, state government cancelled all the contracts. State government cancelled all the contracts. Now the new contracts were given to the state government companies only. So now there is a contract between state government and the state government company. There is a contract between the state government and state government company or a state government undertaking. As per this contract, the state government undertaking, that is the state government company, will extract the coal, sell it in the open market, and whatever coal they have extracted, on that they will pay royalty to the state government. They will pay royalty or fees or service charge. You can use any term, whatever term you want to use, you can use, but ultimately some amount of fees paid by the state government undertaking to the state government. This is an expenditure for the state government undertaking. So state government undertaking is a separate entity. While state government entity prepares its own profit and loss account, they are going to debit this royalty in their profit and loss account. They will debit the royalty in their profit and loss account, and for that royalty they would ask for deduction. For that royalty they would ask for deduction. Will they get the deduction? Answer is no. Deduction is disallowed. Where it is written? It is written in section 40A clause 2B. It is written in 40A clause 2B. See, the language used here is slightly difficult. What it says? Any amount paid by way of royalty, license fees, service fees, privilege fees, service charge, or any other fees of charge by whatever name called, which is levied exclusively on the state government undertaking by the state government. So state government undertaking is paying service charge, license fees, royalty, privilege fees, service charge, or any other charge to the state government, or this amount is appropriated directly or indirectly from the state government undertaking to the state government. In that case, this amount, state government undertaking, while preparing the profit and loss account, they would debit the expenditure, and this 40A clause 2B says this will not be allowed as deduction. This will not be allowed as deduction. Tell me, have you understood this 40A clause 2B? Yes? 40A clause 2B, have you understood? See, this is not relevant for intermediate, but since it is covered by the ICI module, I have taken up. Shruti madam says, sir, please explain point number B. Shruti madam, point number A and B are similar to each other. What it says now, point number B says, any amount which is appropriated. Appropriated means distributed. When you pay royalty, you are appropriating some amount to the state government. State government may take this money either in the form of royalty, or state government may say you, at whatever price you are selling the coal, of that you give us 40% amount. At whatever price you are selling the coal, of that you pay us 40% amount. So if the prices are increasing, decreasing, prices are fluctuating, then whatever is the price of that 40% you pay to the state government. So that can be called as a sharing basis. Instead of a fixed royalty, state government undertaking is paying something to the state government on a sharing basis. Have you understood? Okay. So with this 40A clause 3B is over. Now do one thing. We'll discuss the practical question. We'll discuss the practical question for you. I think it is lot of theory for today. You not be in a position to absorb. Correct? But before I move on to practical question, Dikshit had messaged me, sir, just explaining point number 8. Dikshit, question number 12, point number 8 is nothing but drawings entry. Drawings entry should be recorded in the books of account at what price? It should be recorded at cost price. In this adjustment, what is the cost price? 12,000 is the cost price. But you have recorded the entry in the books of account at what price? 10,000. So can I say you have under recorded the drawings? You under recorded the drawings now. Instead of 12,000, you have recorded 10,000. So these drawings would be credited to your trading account now. So it is credited, but it is credited by 2,000 less. It is credited by 2,000 less. It should have been credited by 12,000, but it is actually credited only by 10,000. So 2,000 is less credit. If you pass lower entry on the credit side, what impact it will have on your profit? If you pass lower entry on a credit side, your profit will fall, na? So wrongly your profit is appearing less. Your profit is on the lower side, but it is wrongly appearing less, na? So what you should do? You should increase the profit. For that we have added 2,000 rupees. That's all. For that we have added 2,000 rupees. Hope this is clear now. Now friends, let us move on to question number 13. Question number 13 is a very big question. It appears to be a bigger question, but there are a lot of adjustments which are irrelevant. There are a lot of adjustments which are not relevant. So we'll start the discussion of question number 13. Profit and loss account of Mr. X. An individual shows a net profit of 5,92,000. So this 5,92,000 will be the starting point of our solution. 5,92,000 will be the starting point of our solution. Profit and loss account of Mr. X, an individual, shows a net profit of 5,92,000 for the year ending 31st March 21. Particulars noted from the accounts are as under. Adjustment number 1 says 2,80,000 is debited to profit and loss account. 2,80,000 is debited to profit and loss account means while computing net profit, that is already deducted. While computing net profit, it is already deducted. That amount is already deducted. Deva, what you have written? I don't understand. What do you mean by sub? Or by mistake? Okay. So 5,92,000 will be my starting point of the solution. 2,80,000 is debited to profit and loss account means it is already deducted. This is debited to profit and loss account as entertainment expenditure, and this is the breakup of the 2,80,000. Number 1, it includes expenditure on lunch given to dealers. 1,50,000 is incurred as an expenditure for providing lunch to your dealers. See, providing lunch to your dealers, don't you believe that it is a business expenditure? You might have kept a meeting with your dealers, and during the lunch time, you have provided free lunch to your dealers. Your dealers are business associates. So if you provide free lunch to them, definitely it is a business purpose expenditure. So it should be allowed as deduction. And since it should be allowed as deduction, what should we do about it? It is already debited to your profit and loss account. It should be allowed as deduction. What should we do about it? It should be totally ignored. It should be totally ignored. So this 1,50,000 will be totally ignored. Next says expenditure on food or beverages provided to an employee in the office factory, in the office and factory. It is rupees 40 per day per employee for 10 employees for 200 days. For 200 days to 10 employees, you have provided food and beverages and you have incurred a cost of 40 rupees per day. So the expenditure is 80,000 rupees. Don't you feel providing food to your employee in the office premises is an employee welfare expenses? And that employee welfare expenses is nothing but a business expenditure. And if it is a business expenditure, it should be allowed as deduction. Will it be allowed as deduction? Yes. Where? Section 37 subsection 1, it will be allowed as deduction. So what should we do about this? Should we add less or ignore? Yes. Should we add less or ignore? This should be totally ignored. So this 150, 80 both will be totally ignored. Next point says expenditure on food or beverages provided to employee at a place other than office, 50 rupees per employee per day for 4 employee for 250 days. See, you provide a food to your employee inside the office or outside the office. It is part of employee welfare expenses, which is a business expenditure, and deduction is allowed in section 37 subsection 1 because it is a business expenditure, it is a revenue expenditure, it is a legal expenditure. All the conditions of section 37 subsection 1 are fulfilled. So this should be allowed as deduction. If it is allowed as deduction and it is already debited to your profit and loss account, what should we do about that? It should be totally ignored. It should be totally ignored. So this adjustment number 1 of 2,80,000 rupees, that will be totally ignored. That will be totally ignored. Have you understood this very clearly? Okay. So point number 1, everything will be ignored. Point number 2. Point number 2. 7,93,000 is debited to profit and loss account as salary to staff. You have debited your profit and loss account as salary to staff amounting to 7,93,000. Amounting to 7,93,000. And the breakup of 7,93,000 is given to you here. It says 793 includes a basic salary of 20 employees at the rate of 2,000 per month. 2,000 per month multiplied by 12 months, that is 24,000. And such 24,000 is paid to 20 employees, that is 4,80,000. This is nothing but a salary. It is a business expenditure. It is allowed as deduction. It is allowed as deduction under section 37 subsection 1. Therefore, this should be totally ignored. This should be totally ignored. Next point is employer's contribution to unrecognized provident fund. See, whenever an employer contributes to any unrecognized fund, it will not be allowed as deduction. Whenever employer contributes anything to unrecognized fund, it will not be allowed as deduction. But if he contributes something to recognized fund, approved fund, it will be allowed as deduction. So this will not be allowed as deduction. What should we do about this? This amount should be added back. So against 48,000, I am putting the sign plus. This we are adding because of section 40 capital A subsection 9. Any contribution to any unapproved fund should be added. Next, entertainment allowance to some of the employees. If you have given entertainment allowance to your employees, that is an expenditure for you. That should be allowed as deduction. It is debited to profit and loss account. It is already deducted while computing your profit. So it should be totally ignored. 45,000 should be totally ignored. Next is salary paid to X. Who is this X? Yes? Who is X? Who is X? X is a proprietor. X is a proprietor himself. This is not a question pertaining to company. X is the owner, X is the proprietor. So salary paid to proprietor is an appropriation of profit. It is not allowed as deduction. So this 96,000 should be added. because this is appropriation of profit. This is appropriation of profit. So 96 will be added. Let's move on to next point. Salary to excess brother 84,000. Excess brother may not get a salary of more than 2,000 per month in any other concern. So Mr. Excess brother, if he works somewhere, he can get a salary of maximum 2,000 per month. So yearly he can get how much? 24,000. But excess paid 84,000. How much extra he has paid? He has paid excess to the tune of 60,000. That will be disallowed by applying the provisions of section 40 capital A subsection 2. How much will be disallowed? 60,000 will be disallowed. 60,000 is extra payment, excess payment. That 60,000 will be disallowed. Next point says medical insurance premium of 20 employees 40,000. If you have paid health insurance premium of your employees, it is allowed as deduction in section 36 subsection 1. It is allowed as deduction in section 36 subsection 1. It is allowed as deduction 36 subsection 1. It is already debited to a profit and loss account. It is already deducted. So what should we do? We should ignore. We should ignore. So out of this point number 2, 3 amounts are going to get added. 48,000, 48,000, 96,000 and 60,000. These 3 amounts will be added. So with this we have completed point 2. We move on to point 3. 30,000 is debited to profit and loss account as interest on capital borrowed for payment of income tax. Interest on capital borrowed for payment of income tax. See, income tax is not allowed as deduction. Income tax is not allowed as deduction. So if you take loan for payment of income tax, then interest on that loan also cannot be allowed as deduction. Interest on loan is allowed as deduction provided loan is used for the purpose of your business or profession. Section 36 subsection 1 clause 3 allows you deduction for interest on loan provided borrowed funds is used for the purpose of business or profession. Here the borrowed fund is used for paying the income tax. Therefore the interest will not be allowed to you as deduction. So this amount is disallowed. This amount will be added back. This amount will be added back. So this 30,000 will be added back. Now next we have point number 4. Point number 4 is related to depreciation. Point number 4 is related to depreciation. Question is silent whether Mr. X is manufacturer or not. Question is silent whether Mr. X is manufacturer or not. So in that case, we can write an assumption that in the absence of specific information in the question, it is presumed that Mr. X is manufacturer. Why such why we are taking assumption? So that if he is manufacturer, he is eligible to get deduction for depreciation. He is eligible to get deduction for depreciation. So I will give you additional depreciation. Yes, if he is manufacturer, he can claim additional depreciation. So I am giving you an assumption that yes, he is a manufacturer, he is entitled to claim deduction for additional depreciation. Now I want 2 amounts from you. I want 2 things from you. I want the amount of depreciation and I want the amount of additional depreciation. So kindly refer to this point. I am giving you 2 minutes time. You give me the amount of normal depreciation. What will be the amount of normal depreciation and what will be the amount of additional depreciation? I need 2 amounts from you. I am giving you 2 minutes time. Kindly refer this adjustment number 4. Try to find out the amount of normal depreciation as well as the additional depreciation. Right now it is 119. So I can wait till 121. I can wait till 121. You refer to this point number 4 and you get me the amount of normal depreciation as well as additional depreciation. Additional depreciation 1,20,000. Arun has given me the amount of additional depreciation 1,20,000. That is correct. Okay. We'll start. Okay, let me read question adjustment number 4 for you. X receives a plant on 10th November 20 from his friend as gift. So here two things are important. Number one is date. 10th November 20. Can you recollect something? 10th November 20. What is the importance of this date? This date is on or after 4th October. So half rule is required to be applied. Half rule is required to be applied. And this plant is received as gift from his friend. When you receive some plant as gift, what becomes your actual cost? What becomes your actual cost? WDV of the previous owner will become your actual cost. WDV of the previous owner will become your actual cost. Further it says the fair market value of the plant on 10th November 20 is 2,30,000. See, this is fair market value. This fair market value is not relevant to us because what is going to become the actual cost is WDV of the previous owner. Rate of depreciation is 15%, that is okay. WDV of the plant on 1st April 20 in the hands of A is 2,60,000. So what is the amount which is relevant to us? Is 2,60,000. 2,60,000 is the WDV to the previous owner. This will be added to the block of asset. This will be added to the block of asset. Now on this 2,60,000 you should not calculate additional depreciation. On this 2,60,000 you should not calculate additional depreciation. Why? Because this is a second hand machinery. Second hand machinery, you are not eligible to get additional depreciation. This 2,60,000 will be added to the block, but while we calculate normal depreciation, this will be taken into account. While we calculate additional depreciation, this will be totally ignored. In respect of this plant, no depreciation is claimed in the books of accounts of X. That is okay. For tax purposes, following points are noted from the books of accounts. Depreciated value of plant on 1st April 20 is 7,10,000. What is this? This is nothing but the opening WDV. This is nothing but the opening WDV. Next line says cost of machine imported from Germany 6 lakh rupees. And this machine is put to use on 30th June 20. 30th June 20, referring to this date, what you can decide is full depreciation will be allowed on this. Full depreciation. And this is the new machinery, na? So additional depreciation will also be allowed. We are taking an assumption that SSC is a manufacturer and all the conditions with respect to additional depreciation are fulfilled. So additional depreciation will also be allowed at the rate of 20%. So full depreciation will be allowed, normal depreciation will also be given, additional depreciation will also be given. Next line, they say sale proceeds of plant sold on 30th March 21. This plant was purchased in 15-16. In the current year, it is sold for 14 lakhs. So they have given you the sale proceeds of plant and machinery. What do you do about the sale proceeds? The selling price you deduct from the value of the block. So this 14 lakhs should be deducted from the value of the block. This 14 lakhs should be deducted from the value of the block. So this 6 lakhs will be added to the value of the block. 14 lakhs will be deducted from the value of the block. 6 lakhs will be added to the value of the block and 14 lakhs will be deducted from the value of the block. Depreciation debited to profit and loss account. This is which depreciation? This is accounting depreciation. accounting depreciation is not allowed as deduction. It is already added to the, it is already debited to profit and loss account. What should we do about this? This should be added back. This should be added back. And then in the working note, we will calculate the depreciation, and that depreciation which is calculated as per the income tax provision will be deducted. So, I am making a working note in front of you. Working note 1. For calculating depreciation. For calculating depreciation. Tell me, what is the opening WDV? First of all, we will calculate normal depreciation. First of all, we will calculate normal depreciation. Can you tell me what is the opening WDV? 7,10,000. 7,10,000. To this we will add assets acquired and put to use. Number 1, machinery imported from Germany. What is the value? Machinery imported from Germany, 6 lakhs. This 6 lakhs should be added. Number 2, plant received as gift. What is the value? WDV of previous owner, 2,60,000. On this 2,60,000 we need to apply the half rule. On this 2,60,000 we need to apply the half rule. Now let me take the total. 7,10,000 plus 6 lakhs is 13,10,000. 13,10,000 plus 2,60,000 is 15,70,000. 15,70,000. Yes or no? From that you deduct selling price of assets sold. What is the selling price of machinery sold? 14 lakhs. 1 for 14 lakhs. That 14 lakhs should be deducted. If I deduct the 14 lakhs, I would arrive at the amount of WDV for charging depreciation. WDV for charging depreciation is 1,70,000. On that I should calculate depreciation. Now you know that up to 2,50,000, up to 2,60,000, I am required to apply the half rule. Up to 2,60,000, I am required to apply the half rule. But what is the value of my WDV? Value of my WDV is 1,70,000. So what I will do? I will apply the half rule on entire 1,70,000. I will apply the half rule on entire 1,70,000. Yes or no? So on 1,70,000, I apply the half rule. Depreciation rate is given to me as 15%. So 1,70,000 into 15% into 1 by 2. This will give me what? 12,750. This is my normal depreciation. This is my normal depreciation. Full value, full rule is not applicable here, because the closing WDV value is less than 2,60,000. If my closing WDV value is more than 260, then 260 will be assigned to half rule, excess amount will be assigned to full rule. But here, since my closing WDV for charging depreciation is less than 2,60,000, entire value of 1,70,000 will be assigned to half rule. So on that 1,70,000, I have applied rate of depreciation 15%, that is multiplied by half, I get the amount of depreciation as 12,750. where on what full rule is to be applied is nothing, 0. So this is my which depreciation? Normal depreciation. This is my normal depreciation. This normal depreciation is always calculated on WDV. Yes, have you understood this? Yes or no? If any one of you are having any doubt, please do ask. Additional depreciation. Additional depreciation is calculated only on newly acquired asset. I have acquired 2 new assets. 2 assets are acquired, out of which 2,60,000 assets gifted is a second hand asset. So no additional depreciation. Imported machinery from Germany, 6 lakhs. On that I am eligible to get additional depreciation at 20%. Full rule, na? Full rule. Half rule will not be applied on this. So 6 lakh into 20% will give me 1,20,000. So my normal depreciation is 12,750. Additional depreciation is 1,20,000. What is total depreciation? Total depreciation is 1,32,750. Total depreciation is 1,32,750. Have you clearly understood this calculation? See, once you understand the provision, once you recollect the provision, then it is not difficult. 132,750 is the amount of depreciation. Now I move on to the question. Once again, I move on to the question. $132,750. My accounting depreciation is 80,000, that will be added, and my income tax depreciation is 132,750, that will be subtracted. So left hand side here margin I am writing 1,32,750. This is my income tax depreciation. This will be deducted. This is income tax depreciation. This will be deducted. So what is the effect of adjustment number 4? 80,000 will be added and 1,32,750 will be deducted. 80,000 will be added, 1,32,750 will be subtracted. Yes, is that very, very clear? Yes, okay. Let us proceed further. Let us proceed further. Point number 5 says 30,000 is given to approved Indian Institute of Technology for carrying out an approved program under section 35(2)AA of scientific research, and 20,000 is given to university for research in social science. The research in approved university for social science and research amount given to Indian Institute of Technology for research for scientific purpose, both are allowed as deduction. I will send you the printed solution, don't worry about that. Everything will be sent to you. I have everything in the soft copy, everything will be given to you. I am not giving you in advance, because if I give it in advance, you will keep that solution in front of you and sit for the lecture. That is the reason. Everything will be provided, don't worry about that. You just understand, focus on understanding. Now tell me, adjustment number 5, it is relating to section 35 scientific research. 30,000 is given to IIT and 20,000 is given to university for research in social science. Both are allowed as deduction. Both are allowed as deduction, and it is debited to your profit and loss account. What should I do? This entire 50,000 is debited to your profit and loss account. It is allowed as deduction in section 35 scientific research. What should I do about it? It should be totally ignored. Point 5 should be totally ignored. Now let's move on to point number 6. Capital expenditure is incurred for setting up and operating a warehousing facility for storage of agriculture produce amounting to 140. Which section comes to your mind? Section 35 AD should come to your mind. Section 35 AD should come to your mind. Capital expenditure incurred for setting up an warehousing facility for storage of agriculture produce is allowed as deduction. See, it is clearly saying X wants to claim the same as deduction under section 35 AD. Is it allowed as deduction? Yes, it is allowed as deduction. So the point is whether it is debited to P&L or it is not debited to P&L. Yes, it says particulars noted from the accounts. Whether it is debited to P&L or it is not debited to P&L is not clearly given. So we believe that it is a capital expenditure. It would not have been debited to P&L. In capital expenditure, generally it is not debited to P&L. Now X wants to claim the deduction for this. So what is the consequence? What effect we would give? We should deduct 1,40,000. We should deduct that 1,40,000. I have made the solution. Here I have deducted 140. In the solution I have deducted 140. So capital expenditure, if you want to write, you can write here. Question is silent, na? So it is not debited to profit and loss account. That is the normal assumption because capital expenditure is never debited to P&L. And this is allowed as such in section 35D. So we are going to deduct. So I am putting the minus sign. Is that very, very clear? Yes or no? So point 6 is over. Let's move on to point 7. An amount of 50,000 is contributed towards employees pension scheme referred to in section 80 CCD. There is an employee pension scheme. In that, employer has done the contribution. Whatever amount employer has contributed to employee pension scheme, that employer contribution is an expenditure for the employer. That employer contribution is an expenditure for the employer, and he has debited to his profit. He might have debited his profit and loss account, and deduction will be allowed to him. So what should we do about this? This amount has been debited to profit and loss account. Deduction is allowed. Sarvanna, 40A9 is not applicable here. 40A9 is not applicable. Deduction is allowed in section 36 subsection 1. You refer to section 36 subsection 1. I will show you. See this, page number 130. Page number 130 in your book. Employer's contribution to employees pension scheme. Deduction is allowed under section 80 CCD. Deduction is allowed in section 80 CCD, but this deduction is restricted to 10% of the salary of employee. What do you mean by salary? Salary is basic salary, DA recognized turnover commission. See, this I have not explained you. This 10% limit I have not explained you because generally we do the chapter of PGBP after doing the chapter of salary. For the first time in my life, I have started the chapter of PGBP before completing income from salary. The only reason was you wanted me to start the PGBP chapter in face-to-face class, so I started. So this point I have not explained. Generally, this point is covered in the chapter of income from salary. When I come to the chapter of PGBP, people will understand this just by referring to it. So what I am going to do is, I am going to explain you the effect of this. I am just going to explain you the effect of this. What it says, 50,000 is contributed towards employee pension scheme and this is debited to profit and loss account. Now you tell me, you have to refer and you have to find out what is the amount of salary. If you refer to adjustment number 2, The basic salary is 4,80,000. Basic salary is 4,80,000. You don't have dearness allowance, you don't have turnover commission in the question. Deduction is allowed for employer's contribution to pension scheme to the extent of 10% of salary. What is the amount of salary? 4,80,000. Of that 10% will be how much? 48,000. So what will be allowed to as deduction is 48,000. How much you have debited your profit and loss account? 50,000. Have you debited excess? Yes. How much extra? 2,000. That 2,000 will be disallowed. So section 36 subsection 1 says employer's contribution to pension scheme will be allowed as deduction to the tune of 10% of salary. Salary is nothing but basic salary, DA recognized, turnover commission. In this point, in this question, we don't have DA recognized, we don't have turnover commission. So you have to just take up the basic salary. Basic salary is 4,80,000. Of that, we have to ascertain 10%, that is 48,000. So section 36 subsection 1 says deduction will be allowed to the extent of 10% of salary. Salary is 4,80,000. Of that 10% is 48,000. So 48,000 deduction will be allowed. But you have debited your profit and loss account by 50,000. So excess debit of 2,000 will be disallowed. Excess debit of 2,000 will be disallowed. So point number 7, left hand side, you put a plus sign. You write an amount of 2,000. You write an amount of 2,000. If you want, you can give a reference to section 1, section 36 subsection 1. You can give a reference of section 36 subsection 1, and you can also write 10% of 4,80,000. 10% of 4,80,000 is 48,000. For this 48,000 deduction is allowed. For this 48,000 deduction is allowed. So it is disallowed to the extent of only 2,000. Excess debit to penal account is 2,000. That will be disallowed. Yes, tell me, is that very clear? Have you understood this point? Everyone? Yes. So with this, point number 7 is over. Point number 7 is over. Now we move on to point number 8. Point number 8 says was, during the previous year 2021, Mr. X has presented 400 diaries to its distributors for advertisement purpose. So you have distributed 400 diaries to your distributors for advertisement purpose. In India, we have the trend of getting the New Year diary printed and giving it free of cost to our business associates to do our advertisement. On the diary cover page, we will write the name of our organization, etc., etc. So the purpose is to do the advertisement. The entire cost of diary is 5 lakh and this is debited to the profit and loss account. These diaries were purchased from a relative on different dates. These diaries were purchased from a relative, means if excess payment is done to relative, that will be disallowed in section 40 capital A subsection 2. The market value of these diaries and other information noted from the books of accounts is as follows. First transaction is 100 diaries. Amount of bill is 1,50,000, market price is 185. Payment is made by account paycheck. First of all, tell me, refer this first transaction and you tell me, have you done excess payment to relative? Have you done some excess payment? Market price is 185, you have paid 150. So it is not excess payment. It is not excess payment. So 48(2) is not applicable. 40 capital A subsection 2 is not applicable. What about 48(3)? 48(3) is also not applicable. Why? Because you have made the payment by account paycheck. So this point number 1, 48(2), 48(3) both are not applicable. Nothing will be disallowed in this transaction number 1. Is that very clear? Yes? Yes, everyone? Okay. Now we have second transaction. Second transaction, 260 diaries are required, bill amount is 260, market price is 2 lakhs. Bill amount is 260, market price is 2 lakhs. Tell me what is the excess payment to relative in second transaction? Market value is 2 lakhs, you have acquired the diaries at a price of 2 lakh 60, excess payment to relative is 60,000 rupees. That will be disallowed in which section? 40A2. So I am writing as section 40 capital A subsection 2. 60,000 will be disallowed here. 60,000 will be disallowed. Now tell me what is the mode of payment? How you have paid money? In cash. So section 40 capital A subsection 3 will also be attracted. Section 40 capital A subsection 3 will be attracted. How much will be disallowed in section 40 capital A subsection 3? Out of 2 lakh 60, 60,000 is already disallowed by applying the provision of 40A2. So what is left? Only 2 lakhs. So on what amount 40A3 can be applied? It can be applied only on 2 lakhs. So 2 lakh will be disallowed in 40A3. 2 lakh will be disallowed in 40A3. Is that very clear? Now, let's move on to the last transaction. 40 diaries are purchased at a cost of 90,000, but the market price is 80,000. So, what is the excess payment to relative? Excess payment to relative is 10,000. So, this 10,000 will be disallowed in 40A2. Payment is made in cash. 80,000 payment is made in cash. Entire 90 is paid in cash, but 10,000 is disallowed in 40A2. So what can be disallowed in 40A3 is only 80,000. 80,000. Yes. So adjustment number 8. What will be disallowed in 40A3? What will be disallowed in 40A2 is 60 plus 10, 70,000. 60 plus 10, 70,000 will be disallowed in section 40 capital A subsection 2. What will be total disallowance in 40A3? 2,80,000. 2,80,000. Yes, have you understood this very clearly? Adjustment number 8, effect is what? 70,000 will be added because of section 40 capital A subsection 2, and 2,80,000 will be added because of section 40 capital A subsection 3. Now we move on to the last adjustment, that is adjustment number 9. In that we are having 7 points A, B, C, D, E, F, G. Small points, quickly it will get completed. Some of the items debit on the debit side of profit and loss account are as follows. Means all these points are already debited to your profit and loss account. First point A, 10,000 regarding expenditure incurred for printing invitation card and hiring and transportation charges of furniture and shamiana in connection with inauguration of new branch opened for expanding the business. See, you opened a new branch for expanding the business and you have incurred a 10,000 rupees cost on the day of inauguration. This expenditure is related to business. This should be allowed as deduction in section 37 subsection 1. Sarvana has written section 35D. Sarvana, this cannot be considered as a preliminary expenditure. Why not? Section 35D, what should be considered as a preliminary expenditure is defined there. If you refer to section 35D, this expenditure is not covered by, this expenditure is not covered. This expenditure is not covered in section 35D. Section 35D, meaning of preliminary expenditure is clearly given. So in that meaning, this point is not covered. So this should not be considered as a preliminary expenditure by applying the provision of 35D. This deduction will be allowed in section 37 subsection 1. This deduction will be allowed in section 37 subsection 1 and is already debited to profit and loss account. So it will be totally ignored. This will be totally ignored. Yes, Sarvana, have you understood? What about others? Point number A. Yes, okay. Let's move on to next point. Point number B. 24,000 is a payment made towards contribution to unapproved gratuity fund. You know that any amount which you contribute to unapproved gratuity fund, section 40 capital A subsection 7 will apply and that will be disallowed. So this point number B will be disallowed. Point number B will be disallowed. Yes, is that very clear? Next is point C. 15,000 regarding deposit made under Own Your Telephone scheme. You know that any amount given as deposit under Own Your Telephone scheme is allowed as deduction in section 37 subsection 1. It is allowed as deduction in section 37 subsection 1. Therefore, it should be totally ignored because it is already debited to your profit and loss account. Next is wealth tax. You know that wealth tax is a direct tax. It is not allowed as deduction. Wealth tax is a direct tax. It is not allowed as deduction. So it should be added back. It should be added back. Now point number E. Point number E. Salary paid to staff 2 lakh without deducting TDS. Now first of all tell me, this salary is paid na, without deducting TDS. Which section will apply here? If you don't deduct the TDS and you make the payment, disallowance is applicable. We have multiple sections na. Section 40 clause A subclause 1, section 40 clause A subclause 1A, section 40 clause A subclause 3. If you pay salary to resident person, section 40 clause A subclause 1A is applicable. In 40 clause A subclause 1A, the disallowance is 30% of the expenditure. And if you pay salary to a non-resident person, then section 40 clause A subclause 3 is applicable. In case of section 40 clause A subclause 3, 100% of the expenditure is disallowed and it is a permanent disallowance. So here point number E, they are not mentioning whether the salary is paid to a resident person or non-resident person. Nothing is mentioned. Nothing is mentioned. So I take an assumption that salary is paid to resident person. Why na? Because if you are having business in India, you will appoint an Indian employee na. If you are having business in India, why you will appoint someone from outside India? You will appoint someone from India only. So you are paying salary to a resident person. Which provision will apply? Section 40 clause A subclause 1A will be applicable. How much will be disallowed? 30% of the expenditure will be disallowed. What is 30% of 2 lakhs? 60,000 rupees. This 60,000 will be disallowed. Yes? Akshaya, have you understood this? You should not apply 40A subclause 3. Normal assumption is salary is paid to resident. Now, point number F. Point number E, 60,000 will be added. Point number E, 60,000 will be added. Point number F, salary paid to staff outside India, 4 lakh without TDS. This time the salary is paid outside India. If you are paying salary outside India, what should be the assumption, normal assumption? Salary is paid to resident or salary is paid to non-resident? When you pay salary outside India, what assumption should we take? Salary is paid to a resident person or salary is paid to non-resident person? Definitely, if you pay salary outside India, it is paid to a non-resident person. So it is covered by which section? Section 40 clause A subclause 3. What is the extent of disallowance in section 40 clause A subclause 3? 100%, and it is a permanent disallowance. Permanent disallowance. So entire 4 lakhs will be added here. Entire 4 lakhs will be added. Entire 4 lakhs will be added. Now friends, let's move on to the last point, point number G. Commission to agent is 2 lakhs on which tax was deducted at source. 20,000 in January 21. So tax is correctly deducted. But you know that tax is also required to be deposited with the government of India within the due date of filing return. And due date of filing return is either 31st July or 31st October. However, such TDS was deposited on 15th June 21. So can I say it is deposited before the due date of filing income tax return, which is 31st of July? Yes. Can I say it is deposited with the government of India within the due date of filing return, which is 31st of July or 31st October? 15th June is before that only. Yes or no? So TDS is deducted as well as deposited. TDS is deducted as well as deposited. So disallowance will not apply. Disallowance will not apply. Point number G, 2 lakh will be allowed as deduction. 2 lakh will be allowed as deduction. So what should we do about this 2 lakhs? It should be ignored. It should be totally ignored. Is that very clear? Question says compute the taxable business income. So you have to compute the taxable business income. I have explained you what is required to be added. I have also explained you what is required to be deducted. Now what you can do, you can find out the taxable business income as part of homework. Question number 13. I have discussed with you everything in detail. Now this you can take up as part of homework and you can ascertain the amount of taxable business income. This you can take it as part of homework and ascertain the taxable business income. Pick up the calculator, start the solution with 5,92,000, add whatever, wherever you put it the plus sign, you add that amount, wherever you put it the minus sign, deduct that amount, and you arrive at the amount of taxable business income. Yes, is that very clear? Yes? So we'll wind up here. Tomorrow morning when we meet, you should have the amount of taxable business income of question number 13. Arun has already given me the amount, 14,79,250. Arun has already given me the amount, 14,79,250. Others can calculate. Tomorrow morning when we start, you should give me the amount of taxable business income of question number 13. So we'll wind up here. If you have any doubt, if any one of you are having any doubt in any of the point, please do tell me. I'll explain you right now. Lecture is completed. Those who have understood everything, those who don't have any doubt can leave. If any one of you are having any other doubt, please do ask. Mr. Redmi, what is your name? 3 point. 3 point. What do you mean by 3 point? Point number 3. Yes? Mr. Redmi? Point number 3. Point number 3 says what? 30,000 is debited to profit and loss account. Dikshit. Oh, when you log in next time you put your name only. While you log in now you have option to put your name. Put your name at that point of time. Point 3 says what? 30,000 is debited to profit and loss account as interest on capital. Interest on capital borrowed. Why it is borrowed? For payment of income tax. Do you get deduction for income tax? If you pay income tax, do you get deduction? No. Correct? Huh? When you pay income tax, you don't get any deduction because income tax is appropriation of profit. Now, interest on loan is allowed as deduction. Interest on loan is allowed as deduction provided the loan amount should be used for the purpose of business profession. Have you utilized the borrowed money for your business or profession? Here, have you utilized your borrowed money for business profession? Answer is no, it is not utilized for business profession. It is utilized for payment of income tax. Therefore, this interest will not be allowed to as deduction. This interest will not be allowed to as deduction. It is already debited to your profit and loss account. It is not allowed at section. So what should we do? We should add. Therefore, we have added. Yes? Anyone else is having any doubt? Yes? No doubts? So we are winding up today. When we meet tomorrow morning, you should give me the amount of question number 13 PGBP income. Thank you very much. Bye bye everyone.